Japan has intervened to prop up the yen. That followed the Bank of Japan's decision earlier in the day to stick with its ultra-low interest rates. The yen had fallen about 20% against the dollar this year. The Bank of England set to raise interest rates to clamp down on inflation. Economists are forecasting a half percentage point increase in the benchmark lending rate. Still, investors see a strong chance of a 3/4 point hike. Bloomberg's learned that Ukraine has seized dozens of tanks left by Russian forces fleeing the battlefield. And that adds crucial weaponry at a time Ukraine needs it. One person familiar with the matter says around 200 tanks were captured, but there's no word on how many of those vehicles were damaged or destroyed. A victory for the federal prosecutors in the case of the documents taken from Donald Trump's Florida estate. A federal appeals court says the Justice Department can use about 100 documents with classified markings in their criminal investigation. The judges paused a ruling by a lower court judge that barred the use of those documents while a special master reviews the papers that were seized. Meta Platforms has been sued for skirting Apple privacy rules. In a proposed class action lawsuit filed in San Francisco federal court, 2 Facebook users claim the company built a secret workaround to Apple's 2021 privacy rules and violated state and federal laws limiting unauthorized collection of personal data. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
we've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't. We've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Well, that's about as hawkish as it gets. Chairman Powell there, the Federal Reserve Chair, Lisa, basically telling you that, yes, we've done a lot in the last 6 months, but there's more to come.
And one of the biggest... Yeah, and apologies there, but one of the biggest issues there for me is this idea that suddenly he's saying it seems very likely that we're going to get a recession.
Below trend growth, is that code for recession, do you think? Do you think they like to lean on that phrase instead of just saying perhaps negative and pretty dreadful?
I mean, that seems to be the politically correct way to do it, but they seem to basically do away with a lot of the soft landing kinds of discussions.
The language has changed, Tom, in the last 6 months. That's for sure. The language has changed in a big way.
Yeah, it has. I mean, the whole thing has changed, and yesterday I thought was absolutely fascinating. I think, John, we're so caught up in producing it and all that, we didn't even have time to realize the originality of what we heard yesterday. And I like your idea, John, that he basically repeated Jackson Hole, because his optionality's gone. He's on a path, let's go.
There was a moment at the start of that, I think he was responding to a question from Judith Smilik of the New York Times, where he basically said, have a look at my Jackson Hole speech. Just in case you misunderstood what I'm about to say, have a look at my Jackson Hole speech. He's probably going to lean on that for the rest of this year, Tom.
Well, she asked rude questions. I don't know where she learned that. I mean,
probably from you at some point here at Bloomberg.
I have no
over
clue.
The years.
Right now, we're looking at yen. Of course, 142.52 gives it back a little bit off the intervention moment. Right now, we'll brief on this with John Farrow asking smarter questions than me. With Jennifer McCune. She's Global Head of Economics at Capital Economics, former Bank of England economist. Jennifer, I was in London. The part of London I was in was boom, 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 and I know that's not the United Kingdom. I did walk up High Road to go up and see Tottenham play a football game, a soccer game, and it was a little bit of a different England. Just to start the basic conversation, because John's better at this than me, how flat on its back right now economically is the United Kingdom?
It does look like the UK economy is in a recession, has recently entered a recession, and it certainly feels, particularly difficult on the street because these problems are really falling very much on households, whereas some businesses, some energy companies may be benefiting from high energy prices for households. This is just a pretty awful situation, inflation rates that we've not seen for decades.
Do you think the fiscal decisions that are going to be made in the next 24 hours complicate the Bank of England decision that will be made in the next 10 minutes?
Yeah, absolutely. I think in some ways, they make things a little bit easier for the Bank of England, setting this price cap, which has already been announced, lowers the peak in inflation from what would have been about 14.5% to more like 10.5%. So that's a bit better from the Bank of England's perspective. But of course, what it's going to be concerned about is the medium and longer term inflation implications of the boost to demand that the Prime Minister Liz Truss is offering, not only from the energy measures that we know about already, but from the tax cuts that we think are to come.
Just to build on that, Jennifer, how concerned are you about the independence of the Bank of England if they have to go into sort of political rhetoric saying right now the policies are such, I mean, they're not going to say this, but for all intents and purposes, especially with the projections, that gets extrapolated out and then used against them. How concerned are you about that?
Yeah. Right now, I'm not particularly concerned. I think the Bank of England guards its independence very, very closely. I think it's likely to respond, have gone through with. We're now expecting a peak in policy rates of 4% next year. So I think the bank's going to do what it can to quash sort of the demand-related price pressures that are stemming from this. But I'm slightly concerned about talk of giving the bank a new mandate or reconsidering its mandate, and if that did stem through to some kind of government intervention in Bank of England policy, then that would be a really worrying development.
Jennifer, a lot of discussion post-Fed yesterday was about what the circuit breaker was for them to pause some of the rate hikes or even reverse them. And it really came down to the unemployment rate in addition to the inflation pace coming down well within that 2% target. Do we have a sense of whether it's the same for the Bank of England?
Yeah, I mean, I think it's similar for all central banks, really. And for the Bank of England, there are lots of similarities to the US. The tightness of the labour market is a real issue. We've had a lot of people leave the labour market on long-term sick, which has made things very tight and has led to some significant labour shortages. So we need to see how that progresses, whether those people come back, whether wage pressures start to fall off, whether headline inflation comes down as sharply as we're hoping it will next year, and of course what happens to gas prices.
What level does it begin to unravel for sterling? It's an unfair question to you. I get that. It's an FX strategist question. But do you have in your head where sterling reaches a stress point? Can you give me a statistic to 4 digits?
No, I don't have a particular number in mind, but absolutely we're looking, but the government's really taking a gamble here that the policies that it's implementing are going to do something to boost growth, start to make the UK economy look a lot better, and maybe give some support to the currency at the same time. But the real risk is that there are just serious concerns about fiscal sustainability, about just how this is all going to be paid for, whether the government's serious about its fiscal targets, which
well, John, you mentioned Martin Wolf of the FT on this.
Oh, brutal in the FT, and many other people have been as well. Just raise a question, Jennifer. The willingness to do QT, to reverse the balance sheet at the Bank of England, how complicated that's going to be?
Yeah, that's complicated. We're looking for confirmation of that policy today. I think it will go through with its plans for a very gradual reduction, but it's going to need to stand ready to abandon those plans if they cause real stress in the gilt market at a time when the government's presumably going to be issuing a lot of debt as well.
This is a tough moment for the UK. Jennifer, thank you. Jennifer Mickey there of Capital Economics.
Yeah, that's great.
Gilt 12 months ago, sub 1%, right now about 330 on a 10-year. We talked a lot about how policy used to complement one another, fiscal and monetary, through the pandemic, totally in conflict now. In the next 24 hours, Tom, we're going to see a big fiscal package announced potentially from this government, and at the same time, you're going to see QT potentially from the Bank of England. Conflict.
My chart of the year, John, is nominal GDP set in US dollars. And basically the United Kingdom, with a boom a number of years ago, you lived it, John, with what you did in Notting Hill. But after the boom, it's been flat on its back for 10 or so years. John, I did some research on this. You know, coming out of the tots, I mean, you go to the Blue Coats pub, you have the Mexicans, it was loud. It's boisterous. I could barely hear myself.
You've loved this experience, haven't you?
But you know, I was bonding with the people of the United Kingdom away from all the shishi people where, you know, American tourists hang out.
Would you get a season ticket if you lived there?
Oh, of course. Yeah, you know, I would. I can't imagine what that costs.
Are you trying to make the move, Tom? That's where I'm going.
No, it's we.
You're making plans. Oh, we
Bramo.
Are going back. I'm not
yeah,
sure Lisa
Bramo goes. We got to pack up the Bramo cam and move to London.
I think the mini Bramos are on board for sure.
There's no question about that.
They're ready to get the plane with us.
100%.
Yeah, vet Bill's
You're
ready to go.
Let them go with us.
Yeah,
they can go.
You're going to stay in New York.
You guys can have a good time.
Jeff Yu of BNY Mellon is going to join us for the Bank of England decision. Lizzie Burden from outside the Bank of England as well. That BOE decision is up next. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Chairman Powell has got one mission, that's to deal with inflation.
The Fed continues to be really focused on the emerging data.
The Fed's trying to get the economy in a position where inflation comes down, and then it can take its foot off the brake a little bit.
The Fed goes through tightening spells and easing spells and pauses.
A soft landing is actually still likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance, and here comes another rate hike from the Bank of England from 1.75% to 2.50 on the interest rate, from 1.75% to 2.50. Lisa, 2.25 rather. I've read that wrong, haven't I? Forgive me. To 2.25. From 175 to 225, 75 basis point hike, 50 basis point hike rather, Lisa. Clean this up. I've completely
nailed that, John.
Well,
absolutely crushed that.
You know, part of this is my fault because he said right before the decision, what do you think? And I said, definitely 75 basis points. And it said 5 Bank of England officials vote for a 50 basis point rate hike, 3 for 75, 1 for 25. It is 50 basis points, but there was dissent. And this is fascinating, John, at a time when so many people are trying to understand, is it good or is it bad for the currency for this Bank of England to go harder?
Wow, I feel bad. 225 to 175. Forgive me.
Guys,
sterling rolling over 112.86. We are now unchanged on the session on sterling, Tom.
The way this works, and Michael McKee has the same challenge as John does, pretending to do it in real time. And the answer is literally 40 headlines come out at once, and they're scrolling by in a blur, and every once in a while, you know, you see this move, this headline, that, and you're off by a smidgen. I think, John, that, you know, it's a challenging moment for the Bank of England, and the verbiage here is going to be fascinating, including these headlines.
Gilt sales as well. Lisa, gilt sales as well from the Bank of England. The vote to begin active gilt sales from October 3rd. So that's going to be very interesting to see what the outcome of that's going to be.
Well, and honestly, is this a hawkish, underwhelming hike? I mean, basically, that's what we're wondering here as we look at a pound that still is off the earlier lows. And I think that this is interesting, but falling nonetheless. And this, to me, is telling because what you're doing is a disappointment. Some people were hoping for a 75 basis point hike. But what is going to be the forecast, and how do they deal with gilt sales to try to also bolster their firepower as they try to combat inflation?
Lizzie Burden's going to clean this one up for me as well. She joined us from outside the Bank of England. Lizzie, your take on the Bank of England rate decision?
Well, economists got it wrong. Economists got it right. Markets got it wrong. This is still the biggest back-to-back hike since Black Wednesday 30 years ago, but it still looks dovish. Remember, the Riksbank's done 100 basis points. In terms of the vote split, you've got Haskell, Mann and Ramsden going for 75 basis points. Dingra going for 25 basis points. So Swati Dingra was the unknown quantity here, the new member of the committee. She replaces Michael Saunders. Interesting to see that she's voted dovishly, but you did expect Mann to go for a bigger hike because she's American. She's more aware of the international context and the impact of the Fed on sterling. Also interesting to look at what they now see as the outlook for inflation. Of course, they weren't meant to give an inflation forecast, but the outlook's changed so much because of the Truss energy bailout. So now the Bank of England says it sees inflation above 10% in the following few months, but I'm pretty sure I've seen in one of those many headlines that Tom mentioned that it adds to medium-term inflation pressure. So actually, there's a risk that you have higher rates for longer because it could overheat the economy down the line.
I think, Lizzie, it's great to see the argument at the Bank of England, unlike what we see in the United States. Do we know from these headlines what Governor Bailey thinks, or does that wait for the press conference?
We've got to wait for the press conference. I've got to say, Tom, I saw the governor earlier. He loves to walk in through the front door, even on Bank of England Day, but he wasn't giving anything away. What we know is that the bank's still saying it's going to act forcefully on inflation. I don't think markets would say that this is acting forcefully on inflation. How much do the MPC know about the Chancellor's plans for tax cuts and whether there'll be supply-side reforms as well included in the announcement tomorrow?
Hey, Lizzie, thank you. Jeff Hughes is going to join us now from BNY Mellon. Jeff, your reaction to this Bank of England rate hike?
I was looking for 75, to be frank, but I think the market will just take it in its stride for the time being. Tomorrow is far more important compared to today, because they're looking at an inflationary impact from the energy support measures over the medium term. But once the tax cuts and national insurance cuts and any other forms of fiscal stimulus come through, that's going to be a different story.
So right now, do you see this as actually stemming some of the declines? Do you see the sort of pound resilience over the past 24 hours is going to stick, or do you think that this just portends more weakness ahead?
Time being, because of the upside inflation risk, and as acknowledged, but tomorrow markets are going to be looking for fiscal credibility. The fact that the Office of Budget Responsibility has not been allowed to publish its forecasts, and I think that has cast a little bit of a shadow over things. But ultimately, these are very large numbers we're talking about on the energy support side. On top of that, you've got tax cuts, limited revenue generation right now. I think the new government's counting on growth.
Jeff, so much of this is, do you have the luxury of economic growth? And you can go country by country to this. On a blended basis, does the United Kingdom have the luxury of economic growth to do these different experiments?
So growth can only be stimulated by deregulation and lowering the fiscal burden on households and corporates. And crucially, with the energy support program, if that helps the household and consumption, 70% of the UK economy at the end of the day, if the household now feels a bit better about going out and spending, maybe we can get growth, but it's still going to be a tricky environment.
Okay, but so the 2.5%, I believe, I'm not read in on this, but 2.5% is the hope of the Truss government. Parse that out from, let's say, 0 out to 2.5. If they get to 1.25, does that help anybody?
To start off with, but it'll still be considered below trend. But just having a growth number alone, I think that's something Beijing's in the business of doing, rather than the old lady of Threadneedle Street or Downing Street, right? So I think that has unnerved things a bit. I mean, when we spoke last time, these are very unmarket things, right? Setting a growth target is an unmarket-like behavior. So that sets out uncertainty. How are you going to try to achieve that? It remains to be seen. But again, the government's about unleashing the consumer and the corporate through tax cuts.
Sterling right now, 113.06, pretty much unched across the arch from 4 a.m. Wall Street time this morning. Jeff, I've got to ask you about yen, about Bank of Japan on this historic day. Maybe it's sterilized, maybe it's not. Who cares? Maybe it's coordinated, maybe it's not. Who cares? Do you have any idea the impulse that they use to make this intervention? I can't figure out the how muchedness of it. How much did they throw at the market to make for a momentary strong yen?
They acted boldly. Bold was the key word, from the Ministry of Finance. $117 billion equivalent in November 2011, right? But that was buying dollars, trying to weaken the yen. This is the other way around, right? So it's asymmetric. I think we're talking, mid-double digits, something like that, to send a statement. To do it consistently, that's going to be interesting. But they're not going to be alone here. I don't believe it's coordinated. But now they've, opened the floodgates. The rest of Asia is going to follow. China's controlling things already. I'm sure Bank of Korea and also authorities in Thailand, Taiwan, for example, but we'll be looking at this. Maybe the SMB can start to think about liquidating some of its dollar assets. That's nearly 40% of their book is in dollars. So will this signal a turn in the dollar led by central banks? I think that's going to be a new theme for markets coming through.
But this kind of rearranges things a little bit. I mean, I was asking this earlier. How much money are Japanese authorities spending to preserve the fiction of yield curve control, to preserve something that really goes against markets that absolutely want to tear it away? How much can they continue to do this kind of thing? Do they have enough money, or is this going to become punitively costly?
Question of Mr. Kuroda as well. I believe $9 billion equivalent was spent, this week to enforce YCC. It would be so much more efficient, if they let that go. Then we could see 135, 130 very, very quickly, and the Ministry of Finance will just push things along. But at this point, still the two things are pulling against each other. It's all about trying to make sure dollar yen perhaps doesn't go through 145, 150 kind of a range, pushing it lower. That's going to be very, very expensive. So we'll see where the BOJ is over the next coming weeks or so.
Hey, Jeff, thank you. Jeff, you there of Bank of New York Mellon on the latest from the Bank of England and elsewhere. 225 on a Bank of England rate, 175 previously, 50 basis point rate hike. And your currency looks like this, 113 on sterling. Positive by about 1/3% at the moment, Tom. And the next event is a fiscal event for the UK.
Yeah, as Jeff, you mentioned, this is a big deal tomorrow. John, what do you look for tomorrow?
We could potentially, Tom, get tax cuts and more spending. And I want some more detail as well on the energy plan. Lisa, we've had some details, I'd say a little bit of clarity around the consumer portion of this energy relief. We need a little bit more, a whole lot more, in fact, for what's going to happen with businesses.
It's kind of interesting that the Bank of England is saying that the energy price guarantee cuts inflation over 5 percentage points in 2023. And this goes to this push-pull of, okay, on one hand, it'll lower headline prices, but on the other, it'll allow people to start investing and spending that much more in other places. I really find it interesting that the pound is strengthening on the back of this, because we actually saw an underwhelming decision based on a number of market expectations for 75 basis points. I wonder if people are to start saying less does more if it means the economy can grow more later on.
The split was interesting, though, wasn't it?
Yes.
5 officials wanted 50, 3 wanted 75, 1 for 25. I wonder what that means for the next decision, Tom, and what that split looks like then.
Catherine Mann owns the high ground on this. She's not once but twice created original research in academics, John. She's hugely, hugely respected. Her work at Citibank and then on to the Bank of England. And for her to go to 75, I think, speaks volumes about where people like Jeff Yu are.
She wanted the front loading. She talked about that a few weeks ago. Lisa Challer's going to join us in the next hour, 8 a.m. Eastern Time, the CIO at Morgan Stanley Wealth Management. Live from New York City with futures negative, about 1/10% on the S&P. On the NASDAQ 100, down 1/3%. From New York City, heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. For the first time since 1998, Japan has intervened to prop up the yen. And that followed the Bank of Japan's earlier decision in the day to stick with its ultra-low interest rates. The yen had fallen about 20% against the dollar this year. Two American military veterans fighting for Ukraine were among those released as part of a prisoner exchange brokered by Saudi Arabia and Turkey. The two were captured in June. 8 other foreign nationals were released, along with more than 200 Ukrainians. Ukraine freed a pro-Kremlin Ukrainian politician and 55 Russian soldiers. President Biden and new British Prime Minister Liz Truss have pledged to work together to support Ukraine. The two held their first in-person meeting on the sidelines of the United Nations General Assembly. The two leaders said they would also discuss unresolved issues relating to post-Brexit trade and the Irish border. Bloomberg's learned that the Securities and Exchange Commission is set to let Wall Street keep payment for new order flow deals. The practice can involve one brokerage routing retail stock trade order to another firm for execution rather than to an exchange. Backers say it's led to commission-free trading, but critics question whether traders actually get the best price. All of this is part of an SEC overhaul of stock trading rules. And the holiday season is starting earlier this year at Target. The retail chain is pushing its holiday discounts into early October to try to recapture its momentum. Meanwhile, Target plans to hire about 100,000 seasonal workers. That's similar to last year's amount. Earlier this week, Walmart said it would scale back the number of holiday jobs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Dijon Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Access Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. With a major energy crisis and possible recession looming, Italy heads to the polls. Keep it tuned to Bloomberg for up-to-the-minute results and analysis of what it all means to you. Bloomberg, your global business authority.
Time will tell if it's enough, but I do think today is an important move in the direction. So there's a lot of talk they might do 100 today. In the end, they didn't. Right. But as you mentioned a moment ago, they essentially got the effect of that, and maybe in a more durable way by putting it into later rate hikes.
Just absolutely fantastic to have the former Vice Chair of the Federal Reserve, Richard Clowder, alongside us as that decision from the Fed came out, and on the other side of the news conference as well, particularly when Chairman Powell wrapped things up much earlier than I thought he would.
That was
got a habit in the last month of keeping things short, I think. The Jackson Hole speech was about, what, 8 minutes long, Tom? And then the news conference stopped 20 minutes early, something like that?
They all improve. Everybody who gets into the bright public lights, they get better as they go along. But this guy's getting more savvy, I think, John. I think he's more taking charge of the moment. And, you know, you and I were talking Tots football while he was ending the press conference.
I had to spin the microphone around quickly so we could pick up. Lisa, almost on the same level as OPEC Plus and those kind of meetings.
Just keep it short. You know, it's pretty clear cut.
15 minutes is all you need.
That's all you
need.
need.
To make decisions that shake the world.
I mean, it makes it clear, right? And if you need any guidance, then just check the speech I just said, because nothing's changed.
I thought, to be honest with you, at this point, because he struggled in news conferences just in terms of the interpretation of the markets sometimes, to see the NASDAQ up 3-4% off the back of a Fed decision. Keep it tight, keep it focused, keep it short, and refer back to earlier material, which is essentially what he did, Tom.
And they're data dependent. That's all there is to it, is Dr. Clarida mentioned as well. Right now, Dr. Fitzpatrick joins. Jack Fitzpatrick's in Washington. And Jack, I want to open it up to the time of the season. The leaves are changing in Central Park. The browning of the leaves is an American tradition. The election nears. And I've always had trouble with it's the economy stupid. I don't buy it for a minute. It's about crime if you're on one side of the fence. It's about a different theme if you're on the other side of the fence. Does inflation really, really matter in what we see November 8th?
Yeah, it does. In this case, the slogan about the economy and its role in politics is a pretty accurate one. It's not always the case, but that's the overriding theme. Yes, crime, the border, those are Republican points of focus, but the economy and inflation is a major issue that the Republicans are running on, and the Democrats have felt the need to try to address. Right. They're campaigning on what they have tried to do, the role of the tax and climate bill, reducing the deficit, the CHIPS bill, that it should have somewhat of a disinflationary effect. It's limited what Congress can do, but that is the topic of conversation as we get toward the midterms.
But a given congressional district, and I know the Cook report came out and shifted some seats yesterday, and to guys like you, that's a big deal. We can identify the Republican non-economy platforms. What are the Democratic Party talking points against crime and the rest of it that the Republicans speak of?
On crime, you have seen the Democrats move back toward the center compared to, that June 2020 conversation about defund the police. The president has talked a lot about funding for the police. And on the micro scale, the fact that they brought back earmarks, I think, plays into that, because you have a number of Democrats all over the country who have given, a couple million here, a couple million there for small town police radios, that kind of thing. That doesn't come across as a major thing, but it's something that a lot of moderate Democrats talk about is funding for local police. That basically is the Democratic response. On the border issues, they have talked past it a bit more. There haven't been major visits to the border by a bunch of Democrats. That's a Republican talking point that doesn't have as loud a response from
Lisa,
Democrats.
the border's coming to Martha's Vineyard. That's what we're talking about.
Well, and putting aside those highly political issues, which are really important, going back, Jack, to the point of police radios for smaller police units, it goes to a larger issue of have Democrats lost the rural vote? What's your view?
I mean, long term, it has moved away from Democrats, but the question is how much can they chip into what has become a Republican advantage. And that kind of thing is the challenge, not only funding for police, but to what extent, I think the key question for a lot of Democrats is to what extent can they separate themselves from the big federal issues that you've heard of and criticisms of the president, criticisms on the economy, and come back with parochial issues. That's why it matters whether it's an earmark for small town police radios, or they come and spend on wastewater. If you can make it almost seem like you're running for mayor rather than running on big federal politics, that is something that helps the Democrats who are on defense now. The parochial politics and things that get to their local issues.
Lisa, earmark. It comes from a livestock term where the ears of domestic animals were cut in specific ways so that farmers could distinguish their stock from others grazing on public land. Gross.
Well, I mean,
it's an earmark.
Clearly, you're reading the Farm Journal, and I have
am.
extensive
I read
experience
it daily.
with the Farm Journal. Just to hear, Jack, I'm thinking about what you just said, and this idea of trying to act like local politicians and run for sort of like local races. How much are we looking at a move away from saying the Fed needs to do what it needs to do with inflation, and increasingly we need to get more jobs, better jobs, bring back jobs, reshore, that kind of talking point for the Democratic Party as they head into a much more perilous economic time?
They largely have not campaigned on either message of, on one hand, this is the Fed's job, or even trying to say, well, look at the flip side of the coin, that jobs came back, there was a jobs recovery so suddenly. Really what they have campaigned on is the limited opportunities that they have had in Congress to address inflation. The Democrats are campaigning on the Inflation Reduction Act, which may not be the most accurate name, that it reduced the deficit. On the CHIPS bill, that kind of thing that should have a disinflationary effect of some sort. To be honest, probably the role of the Fed is downplayed on the campaign trail, even from Democrats, because they at least have a couple talking points on bills that theoretically would have a disinflationary impact, and it's much more advantageous to talk about what you did do, even if it doesn't have a huge impact on inflation, rather than sort of shrug and say that's up to the Fed. So the talking points are more on what Congress has managed to do, even if it may be fairly limited on inflation.
Hey, Jack, thank you. Jack Fitzpatrick there down in D.C. I just wonder how quickly this changes. This Federal Reserve is engineering a slowdown that is set to lead to higher unemployment, and that is not a bug. Lisa, that's a feature of what they're trying to achieve.
How much longer can all politicians on both sides of the aisle say the Fed needs to do what it needs to do? It is their job to bring inflation down. When does that start to change?
Futures negative 0.2%. Yields higher again on a 10-year, 356.34. From New York, heard on radio, seen on TV. This is Bloomberg.
ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Equities a bit lower, rolling over here, down 1/3 of 1% on the S&P. On the Nasdaq 100, down 5 or 6/10 of 1%. Soft and negative on the Russell. The small caps down 4/10 of 1% also. In the bond market, you know the theme, don't you? Yields higher, yields a bit higher again on a 2-year by 6 basis points to 4.1137%. Just sit on that for a minute. 4.11% on a 2-year when we were trading 12 months ago at something like 20 basis points, Tom. And even at the start of the year, something like 70-something at the start of the year, just a monster change.
It's like back to 1875 or something.
Everything has to reprice off that, Tom.
Yeah,
everything.
I agree with that. I agree with that strongly, that we reprice off of short-term paper, and that's certainly what we're seeing, and that's into this liquidity discussion. John, important research coming out on the history made today by the Bank of Japan. George Saravelis with always a sharp note, and he models out maybe something in the order of 1% of reserves were used on this intervention exercise. We'll know at the end of the month, he says. But far more importantly, this is what it's about, credibility and about use of reserves. And I love what Jeff Yu said earlier. This is asymmetric to the reverse currency war, John. This is a nation that wants to strengthen their currency. That's way harder to do than to weaken your currency.
Whistling in the wind, Tom.
Yeah.
They've got the FX reserve, sure, but they need the underlying policy to shift. If it's the Fed or if it's them. The Fed's going hard, and this is why 2s10s is shaping up as follows. 2s10s.
Look at sterling, John. 112.86
basis points.
I'm looking at the 2s10s.
You can take a look at sterling too, because you look at the front end of the yield curve on gilts. 2-year bond yield up 13 basis points.
Wow.
Just big changes all round, Lisa, at the front end of the curve, and really shaking things up in the FX market.
Yeah, this yield curve inversion is not doing any favors to any of the banks, possibly the reason why people are not getting more income when it comes to their deposits. I'm watching the banks today, in particular when it comes to European banks. We've been talking about Credit Suisse yesterday. I did not make any recommendations in the break whatsoever, but we did hear from Financial Times reporting this morning that they're considering a plan to break the bank up into 3 different units, including a bad bank, and then selling off structured finance units in the United States, potentially cutting thousands of jobs. This is all of the speculation as reported by the Financial Times. Those shares lower by about 1% in pre-market trading. Year to date, it's been a much more punitive kind of pathway. We'll get to that in a second. But Deutsche Bank, interestingly, is up 5.5% today in a sort of tale of 2 banks that once were lumped together. And this comes as Bloomberg is reporting that they are potentially going to put out revenue guidance at the upper end, that they're actually doing better than they had previously expected. If you take a look year to date, you can see both have suffered dramatically, in line with the banks, and possibly much more so for Credit Suisse. Credit Suisse shares 48% decline to $5 if you look at the ADRs so far this year. Deutsche Bank shares down a little bit more than 30%. How much more is there? And Tom, you've been talking a lot about Credit Suisse. How much is there a remedy here, or is this going to just be a sort of slow bleed? It seems like the Financial Times reporting that they're going to have some sort of pretty major restructuring.
Well, this is a zombiness, Lisa. I'm sorry. We've got a risk-free rate now. As Taleb says, it's about physics. Finally, the gravity's back in physics. These are important statements. I mean, is Credit Suisse a zombie institution? That's really what this comes down to. I don't mean to be rude, but that's the question.
Well, they're trying to isolate some of their zombied or their sort of devalued assets in a bad bank, trying to isolate that so that they can save parts that really are functioning. Let's see, Tom.
Let's cut to the chase right now on fixed income. And again, yield is an equivalent to a price of money if you read Fibonacci 101. The Bloomberg Total Return U.S. Aggregate Index is back to where it was on price in early 2019. Ed Al-Husseini is Senior Interest Rate Strategist at Columbia Threadneedle. 2 weeks in a row he's joined us. It's just too much. Ed, good morning, and thank you so much for joining us again. What is the ramification for retail and institutional non-spread investors to see the bond price in the U.S. back to the spring of 2019?
Yeah, look, I think on a total return basis, this has been an exceptionally painful year if you're exposed to interest rate duration. Really from two perspectives. One, outright yields have increased from exceptionally low levels, and so therefore we delivered those negative returns. But also the correlation of rates to risk has turned positive. So you're not able to offset the negative return in duration with positive return in risk assets. So it's been an exceptionally painful period.
Tell me about international bonds, notes, and bills. You've got currency to play with there, currency front and center in the discussion. Are you looking completely domestic at Columbia Threadneedle, or are there opportunities in the international carnage?
No, we're looking across the board, and to your point, the Bank of England, the Fed, the European Central Bank, and obviously the Bank of Japan are at different stages in their policy normalization process, the Fed being most aggressive, but the Bank of England and the ECB catching up, and obviously the Bank of Japan has continued to ease. I think that creates really interesting relative value opportunities in both the rate space in FX. In FX, no doubt, the dollar continues to dominate developed market currencies. But in the rate space, as the Fed gets more aggressive and as the inflation problem in the U.S. is in some ways more tractable than the inflation problem in the U.K. and in Europe, relative value in U.S. rates, in my mind, is becoming a lot more attractive versus the U.K. and core European rates.
So are you saying, Edward, that you would be going into 10-year treasuries right now?
Yeah, and again, I think we have been a little bit early in this view, but as the Fed continues to regain that credibility in the front end and bring forward the probability of a recession, the long end should naturally be a safe haven and a more attractive place to be. Now, what we don't know is what's the final destination, what's the terminal rate. We think we have a decent amount priced in terms of where the Fed could go, about 4.5%, a little slightly north of 4.5% by next year, but that should create value in the long end. We're not quite there in the UK and in Europe yet.
Priya Misra of TD Securities agreed with you yesterday, and she said that we do seem to be getting close to peak rates in the 10-year yields, that she's starting to see some attractiveness there. How much does this give you confidence to go further down the risk spectrum to, for example, investment-grade credit in the United States, other aspects of corporate debt where it doesn't seem like the credit risk is that massive, but you are getting more significant yield?
Yeah, we've liked the front end, so short maturity investment grade debt. Again, in the background, corporate balance sheets remain very healthy. They continue to deleverage in the investment grade space. And short maturity investment grade debt benefits both from the rate kicker from treasury rates rising, north of 2%, north of 4% on the 2-year note. And of course, spreads being exceptionally volatile this year, so getting both a spread kicker and that high starting level of yield. So the income component there to me, looks quite attractive right now.
Spread Kicker was such a great band. I loved what they did with Nickelback. Ed, I'm looking at the U.S. Aggregate Total Return Index. It's a 5 standard deviation move down, looking on a 30-year great disinflation, great moderation trend. Critically, we moved from about +3 standard deviations. We've had a 7 or 8 standard deviation move in your bond world. How do you make it back? In equities, you grow revenues, you make it back. How do you make back these losses in bonds?
I think income is going to be the key component. We will claw back. This process will take some time, no doubt, given the drawdown this year. But the starting level of yield and therefore forward-looking income right now is looking pretty good. Again, look at real rates. 10-year real yields are north of 1%. Obviously, nominal rates are quite elevated as well. And so the expected income going forward is quite attractive. And I think that's going to be a much bigger component of total return from here than it was, say, several years ago.
Ed, wonderful to get your thoughts today. Thanks for being with us. Ed Al-Husseini there of Columbia Threadneedle Investments. And I'm sorry we keep missing you in New York when we're in London. He's in London when we're in New York. Want to look at one currency pair.
Next week.
Euro-Swissy. Euro-Swissy, Tom. This move, this is a 2 percentage point move.
Right.
Against the Swiss franc in the euro's favor after a 75 basis point hike from the Swiss National Bank.
This is exactly what Jeff Yu was talking about. It's asymmetric. I just did a comparative standard deviation study. You can do this on the Bloomberg terminal, folks, in seconds. John, the move in weaker Swiss franc this morning on a standard deviation basis is more substantial than the attempt by the Bank of Japan to strengthen yen, and that's the asymmetry Jeff Yu was talking about.
Is this what happens, Lisa, when you don't deliver a 100 basis point hike and you only go 75? I mean, it's a major move, 2% on an FX pair like that one.
And yet, we're not necessarily seeing the same kind of weakening in the pound, even though they didn't come in on the more hawkish side with respect to their rate hike. And then you saw the Swedish central bank come in with a 100 basis point rate hike, and the currency still sold off. So, I mean, try to make sense of this in terms of how you respond to different central bank parameters. Very difficult.
I'm looking at yen crosses in G10, just a snapshot on the Bloomberg WCRS Go. For those of you interested, change the base currency to the yen and you get a decent picture of things. The yen's eating into everything. Against the Swiss franc, Tom, it's a 3 percentage point move against the Swiss franc.
Well, go north-south Pacific Rim. What's the Aussie yen look like off WCRS?
You want me to have a look at Aussie yen right now? I'll do that for you very quickly. In real time, Tom. Aussie yen at the moment, it's a move of 1.4% in the yen's favor.
There you go. I mean, these are seismic moves we're going to keep abreast. We say equities, bonds, currencies, commodities, and I'm sorry, they all link together. Somehow, Swiss franc movement links into Apple Computer.
Futures right now, down 0.2% on the S&P. You might have to explain that one later, Tom. The Nasdaq down 1/3%. Yields higher by a couple of basis points, 355. Those were the days when the central bank wanted a weak currency, would buy foreign stocks. Tom, all that craziness, no more.
Yeah, well, it's historic times, and frankly, John, looking at the screen, getting scale here is tough to do. It's changed.
From New York,
big time.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Bank of England have voted to raise its benchmark interest rate by a ½ percentage point. 3 of the 9 members wanted a 75 basis point hike. That could build up expectations for a bigger rate increase later this year. Bloomberg's learned that Ukraine has seized dozens of tanks left by Russian forces fleeing the battlefield. That adds crucial weaponry at a time Ukraine really needs it. One person familiar with the matter says around 200 tanks were captured, but there's no word on how many of those vehicles were damaged or destroyed. Shares of Robinhood are surging. Bloomberg has learned that the Securities and Exchange Commission will stop short of banning payment for order flow. That's a major source of revenue for the brokerage. The decision is a win for brokerages that get paid for processing rights. Goldman Sachs has cut its 2023 economic growth forecast for China. The firm predicts that Beijing will stick to its tough COVID-0 restrictions through at least the first quarter of next year. Goldman says China's GDP will probably increase 4.5%. That's down from a previous projection of 5.3%. And Amazon has lost a bid to exclude its billionaire founder, Jeff Bezos, from having to testify in a Federal Trade Commission probe. The company filed a petition with the FTC last month, arguing that the agency's information and interview requests were unduly burdensome. Now, Chief Executive Officer Andy Jassy was also included in the failed bid. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
With respect to the expectation that inflation will
fall, and will fall quite dramatically with what is priced into that dot plot, to those median estimates. The market is there, but it's important to remember that the FOMC's projections can be wrong. The market can be wrong.
Just a fantastic lineup yesterday after the Fed decision and news conference. Thank you to everyone's contributions. Matt Lazzetti of Deutsche Bank, Priya Misra of TD, Scott Minerd of Guggenheim, of course Richard Clarida, together with Jeff Rosenberg of BlackRock, Diane Swank of KPMG. How could I leave Diane out? Just a fantastic lineup yesterday, and thanks to all involved. Futures right now down about 0.25% on the S&P 500. A lot of Southside research coming through. This from Citi moments ago. It's pretty straightforward. Quote, Powell and the committee plan to move nominal rates above underlying inflation, resulting in millions of newly unemployed individuals, to relieve inflationary pressures. This is not a positive scenario for risk, Tom.
Now we see it with the VIX 27.86, a spike up to 30 during the carnage yesterday, but we come back down and have to see how equities play out. We've got 8 ways to go here on radio and television across America this morning. We go to Britain and what John knows, and I get lost in the streets. You go out, I can't pronounce them right, Leadenhall and Fenchurch. John, you go beyond the Bank of England, out past, that pub where I have a beverage of my choice, and you end up out in the world of David Blanchflower. I think it's called Aldgate, John.
Okay,
and you end up in a different London than the fancy stuff we're talking about every day.
Danny Blanchflower joins us right now. Danny, it's fantastic to catch up, and I think we should start there. At the heart of these decisions, what do these decisions mean for everyday Brits, everyday Americans, when Citi are basically saying millions are going to end up unemployed? And the question I've asked, and I think you're perfectly positioned to try and answer it, is higher unemployment a price worth paying to try and get inflation down?
No, well, we have a lot of evidence. I mean, the central bankers forever have said how important inflation is, and they just kind of guessed it. So there's a huge body of literature that I've contributed to, and we look at what's the impact on the country's well-being, if you like, on the wealth of nations, of a 1 percentage point rise in unemployment compared to a 1 percentage point rise in inflation. And the answer is it's absolutely clear, between 5 and 10 times worse. So a new paper says that the rise in unemployment that they're going to bring about is 10 times worse than the problem they're trying to solve. And you started this thing out. I've been talking a lot about the woman on the Mile End Road omnibus. And what I mean by that is, so the Bank of England sits in the City of London. 1 mile away is the Mile End Road. It's called the Mile End Road because it's a mile from the city, and it's where the two worlds collide. And the question is, what's going on that's going to help the bankers and the city folks that we talk to, and the woman riding the bus on the Mile End Road? Right. And the answer, it seems to me, is that we're seeing disaster coming. We're seeing rises in interest rates in the UK when the Bank of England's agents today talk about slowing demand, slowing output. The Bank of England forecast before the rate rise that there's a high probability of deflation and that output is going to fall over the next 3 years. So what are they trying to do for a problem that's not about demand-driven inflation? And the other thing, John and Tom, I think we really should think about, in a sense, you guys talk about this all the time, but there's so little dissent. The story at the ECB, the story at the Bank of England, the story at the Fed. We've got to do things about inflation. We've got to raise rates. Okay. Potentially, this is going to crash the economies, and it'll all be much worse.
Professor Blanchflower, I stood in the bottom of our building here in New York with Secretary of Treasury Tim Geithner in the heart of the financial crisis, and Geithner brilliantly laid out that they needed to extend the x-axis and use time to heal the wounds. Are these central banks that are panicking because they refuse to extend time, to extend the x-axis, to diffuse inflationary impulse?
Well, that's absolutely right, Tom. I mean, the thing that strikes me as very interesting is these central bankers seem to want to respond to every piece of minutiae that comes in every day. Their job is to focus on the forecast horizon, what inflation is going to be, let's say, in 2 years' time. But if that causes all kinds of problems, there's no reason why you shouldn't say, okay, let's let inflation come back to target in 3 years or 4 years. I mean, that's absolutely allowed. And the sensible thing probably to do is to see if this temporary shock dissipates. So you could sit there and say a sensible path would be to sit and wait and watch. But again, where's the dissenting voices? They're all saying the same thing based on zero data. They have no precedent to this. And the danger is that the soft landings are not going to come. I mean, the forecast yesterday from the Fed said output's going to be fine, unemployment's going to rise just a little bit, and raising rates to 4.5%, no worry, it'll slowly bring inflation down. And that's for Gaga land. That's not going to happen.
Danny, are there any circumstances under which you would argue for raising rates?
Well, of course, obviously. I mean, absolutely.
So what are the scenarios that would cause you to say it is important to tighten financial conditions?
That's a stupid question in a way. I mean, what we've seen since 2008 is the mother of all shocks. We saw the mother of all shocks, negative shock to output in 2007-8, which you had to counter. If you hadn't counted it, Ben Bernanke said unemployment would have been 25%, so I buy that. So now what we have are giant shocks. I mean, a giant shock from the COVID and from the war. We don't know how it's going to recover. So why would I want to punch the labor market and punch demand before I really know what's coming? I mean, it's as if they know what's coming because they clearly don't. So under these circumstances, supply-driven shock that essentially is going to drop out. My guess in the United States and in the UK, we'll see very low inflation by June as those big numbers, one-off big numbers that we saw dropped out. So I would have not been voting for rate rises because of the large negative shock. And the debate over the last decade is about the scale of that negative shock.
Danny, it may be a stupid question, and yet some people might be wondering that because they're taking a look at CPI where it is and saying, why wouldn't you want to raise rates? So, I'm just saying this. So, from your perspective, what data point would you be watching to prove your point every week?
Okay, so let's just go with the claims that the Fed has made and the claim that I make. So what you got was a couple of once-off events, which are basically driving the base effects. You've had inflation of 0 and 0.1 in the last 2 months. If you just take 2012 to 2019 and you impose those inflation shocks over the next 8 months, inflation gets to 1 by about June. If you go back to 2008, same date, July 2008, inflation was 5.6%. It was -2 a year later. So the question is, everything's being driven by the base effect. So I would be watching and waiting.
Danny Blanchflower, thank you, sir.
What a clinic, thank you.
I thought it was a phenomenal question, by the way, Sir Brown.
We hope so, but not now.
I've just never heard Danny ask for a rate hike, so, I was interested too. Danny, thank you to Lisa as well, to Tom Keane. From me, I'm going to go get a wisdom tooth removed now, Tom, so you're flying solo.
I caused that, it's my
You
fault.
two together.
Yeah.
Into the
John, I
bell.
just opened my monthly statement, and that Austrian I bought, remember the end of 2020?
Yeah. How's that going?
The 98-year Austrian? I'm down 65%.
That was the first time you dabbled out of cash.
Yeah, I did.
I remember. Triple leverage all.
Back then it was 100 years. I'm down 65% on that puppy.
Futures, Tom.
You
Unchanged
okay,
on
John?
the S&P, just about.
Should Lisa go? She can hold
Get
your
in
hand.
touch with me in an hour and see if I'm okay. In the NASDAQ, we're down
This
about
won't hurt.
1%. From New York, this is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done.
They need to risk a recession in order to bring inflation down.
That doesn't mean the Fed won't make a whole new set of mistakes, which is what I'm worried about.
It's important to remember that the FOMC's projections can be wrong. The market can be wrong.
Time will tell if it's enough, but I do think today is an important move in the direction.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene.
Connection
John
lost.
Farrow, out seeing Doctor, do you floss? Very important moment for him, and we hope he has our prayers. He has our thoughts and prayers. Lisa Abramowitz and myself will get you through this truly historic day after the Fed meeting. Lisa, just to generalize for radio and TV, Powell acted, many respond.
Yeah, and it's not just with respect to the markets, but also central bankers around the world. How do you readjust at a time when the dollar is ascendant, when you have this Federal Reserve that is going to keep hiking until it sees the whites of 2% inflation's eyes, right? And this really is going to offer up a real conundrum for central banks globally.
It is, and of course, folks, the intervention in Japan is absolutely historic. I love moments ago, Lisa, Ben Emmons with an exceptionally thoughtful note at Medley, and he frames it right back to 1998, right back to 2011, and that there's more work to be done, not only in intervention, but also in this crazy yield policy they have.
Okay, so here's the question. How far can they go with this, right? I mean, basically, what was the note that you were pointing out that George Saravello's put out there, that 1%
1% of reserves is a working number right now.
That was what they used to create a little bit of a floor, at least for the valuation here versus the dollar for the yen. How much longer can they go? And what happens to markets? Do you get that breaking point? And I think that that's actually one of the key questions going forward. When does some of this market activity become unruly? When is it something that has to be I guess, addressed in something more cohesive.
We're going to dash to the data check right now because our guest is so important on what to do with your assets, your money forward. Lisa, help me here with the data check. So much going on. Equities give me a mixed story. The VIX went out above 30 and pulled right back into 27.68, maybe a more quiescent response. The Dow just still above 30,000, didn't get to the 29,000 level. Lisa, what do you see in bonds this morning?
Well, what you're seeing is a front end that just won't quit, right? 4.11% on that 2-year yield, and I think that's really important. Also, though, in the currency space, and this sort of goes to the theme that we've been talking about over the first 2 hours of the show, how do other central banks respond to this? The Swiss National Bank raised rates by 75 basis points, officially left the negative yield regime, which had been an 8-year regime, and their currency is weakening the most since 2015. What is the path ahead in this currency war to get a stronger currency at a time when nobody wants anything other than the dollar?
For those keeping score at home, let's be clear. The Swiss went one way, the Japanese went another way. Maybe that's called a currency war, Lisa?
I mean, and a very different one than the ones that we're used to over the past couple of decades.
That's really, really important. As Jeff, you said earlier with BNY Mellon, it's asymmetric, to say the least. We need to solve the carnage in your portfolio. Lisa Shallett with us, Chief Investment Officer, Morgan Stanley Wealth Management, and we readjust this morning. Are we rebalancing, Lisa? Are we readjusting? What are we doing amid the carnage?
Well, look, our advice to our clients is certainly that we should be rebalancing here. You know, what we have said is this is a time for active risk management. And what we mean by that is taking a maximum level of diversification. That means diversification by sectors, diversification by technical factors, diversification, by region. I know it's not popular right now, to speak about, American investors owning non-U.S. stocks given relative outperformance of the last decade. But we think that what's going on in the currency markets is material, and that this divergence ultimately will mean revert, and that there is going to be some catch up. So we're recommending, maximum active management, diversification, and things of that nature.
I really look forward to speaking to you because I want to talk about this strange word scale. And I'm going to go back to the great Peter Lynch at Fidelity, who got angry one day and he said, look, I care about your 47th stock pick, not your number 1 stock pick. There seems to be so little to choose from, Lisa, a la Mike Wilson. How do you get scale or diversification within U.S. equities now if you've only got so many good ideas?
Well, I actually, I might push back on that. I think that, underneath the surface of the S&P 500 index and even the NASDAQ indices, we're finding real opportunities. There has been carnage in this market. We know that in small and mid-cap land, there's been carnage. We know that there's a host of sectors that have sold off aggressively, including things like home builders, again, contrarian perhaps, but where, a lot of the bad news or likely news is discounted. And so we do think that there, are things to accumulate out there if you are willing to do the fundamental work. I mean, I think one of the challenges for a lot of investors is the last 13 years have been dominated by a handful of stocks in the U.S. with a growth orientation in the tech and communication sector. And people didn't have to do much work because they could just buy the index and get the job done. This is going to require homework navigating in these markets. And this is when active managers actually, for good or for bad, earn their fees. And, we think that is the place to be.
Does that mean, Lisa, that you think the headline figure for the S&P, for example, could trade sideways for years?
I do. I am, more in that camp. I mean, I think that one of the things that has continued to surprise me is the extent to which equity investors have been willing to hold the levels of forward multiples that we're holding in the face of decade high interest rates. We know mathematically and fundamentally that the movement in interest rates higher should equate to lower price earnings ratios. And, yes, have we pressed down a bit from where we are in January as the Fed funds has gone, from 0 to, 3? Yes, we have some. But, that we're also in the camp that the current figures in terms of estimates for forward consensus earnings estimates for 2022 full year and then 2023 probably remain too high, especially if we're in this debate about, recession, no recession. And so while, the current pricing in markets at 3,800 and change may suggest, a sub 17 times forward multiple, if you adjust those earnings down, we might be back at 17 and a half, 18 times forward. And so this market has more work to do in terms of quote unquote getting real.
So who is going to be the leadership? And I ask this because it sounds like in your scenario, big tech cannot be it anymore.
Correct. I think big tech is going to have to consolidate, and I think those valuations are going to have to come in. And I think that they're going to have the come to Jesus moment, which says, yes, these are great companies, but they are no longer great stocks because everyone knows the stories and expectations are extraordinarily high. The reality is that they do operate in the whole big, wide world, global world. The global world is slowing. The U.S. dollar is a material headwind, and inflation and cost pressures are realities for them as well. So new leadership, from where we sit, is likely to come from different areas like healthcare, areas like energy, industrials that may benefit from some of the infrastructure and capital spending that we think is going to occur over the next couple of years.
Lisa, are we at a point, and I'm thinking of Andrew Mellon in the 1930s on transactions and combinations. Are we at a point where the zombies roll up? I mean, we finally at a point where the real interest rate market, which was a gift the zombies had for 17 years, whatever the number is this the point where the zombies end?
I love what you're saying, Tom, because I do think that is going to be the next phase here, where the cost of capital does start to pinch. I do think that those who have strategic capital to deploy are going to be able to go out and acquire some capabilities. At the same time, I think some of those zombies are going to go by the wayside and starve from not being able to get financing.
Lisa, got to leave it there. Lisa Shallot, thank you so much. Terrific brief there on actually what to do with your capital with Morgan Stanley Wealth Management. You think of Where Are the Zombies, Lisa? It was a Rush song. I can't remember. Moving Pictures. I can't remember which album it was on. But, I'm going to say, Lisa, forward, I'm all over this. I've mentioned Nassim Taleb a couple times this week, where all of a sudden the G is back in physics, the gravity's back, the risk-free rate. You can actually do a Sharpe ratio now. And to me, all these zombies disappear in one way or another.
I'm going to have the Cranberry song in my head for the rest of the day. This really does hinge, though, on this question of financing. And Lisa Shallot pointed to this, right, that it's going to get more restrictive. It's going to get more difficult for them to find the financing in a cheap way in an era of high interest rates and increasing credit risk, and we're not seeing it yet. And this goes back to the Bob Michael point of JP Morgan Asset Management in his conversation with Jonathan Ferro, where he was saying this is actually a huge point of argument within his team. Do you buy at yields that look good at 8% all in, or do you wait for them to become 12% because suddenly people are not going to finance those zombies? And this is one of the key questions.
That's called doing an Austrian debt. Look at
You're still burned from that, huh?
Really worked out. Sterling on this day of the Bank of England, 113.17 on the edge of unched. Please stay with us. Coming up, Abby Joseph Cohen.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Bank of England have voted to raise its benchmark interest rate by a half percentage point. 3 of the 9 members wanted a 75 basis point hike that could build up expectations for a bigger rate increase later this year. For the first time since 1998, Japan has intervened to prop up the yen. That followed the Bank of Japan's decision earlier in the day to stick with its ultra-low interest rates. The yen had fallen about 20% against the dollar this year. Two American military veterans fighting for Ukraine were among those released as part of a prisoner exchange brokered by Saudi Arabia and Turkey. The two were captured in June. 8 other foreign nationals were released, along with more than 200 Ukrainians. Ukraine freed a pro-Kremlin Ukrainian politician and 55 Russian soldiers. Shares of Robinhood, they are surging. Bloomberg has learned that the Securities and Exchange Commission will stop short of banning payment for order flow. That's a major source of revenue for the brokerage. The decision is a win for brokerages that get paid for processing rights. And the holiday season is starting earlier this year at Target. The retail chain is pushing its holiday discounts into early October to try and recapture its momentum. Meanwhile, Target plans to hire about 100,000 seasonal workers. That's similar to last year's amount. Earlier this week, Walmart said it would scale back on the number of holiday jobs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
In order to punish the aggressor within the institutions. We shouldn't turn a blind eye to propagandists who justify aggression, but apply a full package of personal restrictions against them. That is a punishment for lying.
Let's get out front. And on this year of 2022, let's suggest he could be Man of the Year for Time Magazine. Mr. Zelensky of Ukraine, and of course, Ukraine that has had a momentous 14 days in their war with Mr. Putin. Lisa Bramwitz and Tom Keene in New York. This is a week of, well, Lisa, traffic in Midtown Manhattan. Yeah. How about that traffic that we all see with thousands descending for the United Nations General Assembly meetings and much more. Far more importantly, there's a migration in October to the meetings of the International Monetary Fund in Washington. Someone who knows the schedule is Sergei Nikolaevich, Deputy Governor of the National Bank of Ukraine, and we're honored that he could join us today amid a terrible, terrible war. I need to go, first of all, to a simple anecdote of your Kyiv. You were educated in Kyiv. You have seen the transformation over 20 years. How does Kyiv recover back to what you knew when you were younger? How do you see that happening?
Actually, Kyiv changed dramatically for the last 20 years. Before the war, it looked like a normal European city, capital of the European country. So you was able to enjoy the restaurants, clubs, shopping malls, and so on. Definitely change was sizable since the beginning of the war. So Kyiv was completely empty in March, April. Mm-hmm. So nowadays the life is recovering, coming back, yeah, but right. Still you feel the consequences of the war on each step.
Georgieva of the International Monetary Fund has a few distractions away from your war. Mm-hmm. What is your unique message to the International Monetary Fund as you cry for help? What is the distinction you say versus all the other headaches they have around the world?
Definitely Ukraine needs the support from the International Monetary Fund. So we are very grateful for the International Monetary Fund for providing us $1.4 billion under the RFI at the beginning of the war. But so far we need more, and we are ready to engage into the full-fledged program. So mainly we focus our efforts in order to launch the EFF program of the large scale, and the authorities are fully functional and ready to negotiate and to discuss the policies in order to launch such type of program.
Sergey, we've been talking a lot about central bank rate decisions over the past week, and we've gotten a lot of them in the past 24 hours. You recently kept the rate unchanged. How do we even have monetary policy and try to keep a normal sense of monetary transmission in the face of a war, in the face of such incredible disruption in day-to-day commerce that it becomes sort of not really a main feature?
Yeah, definitely. Our approach to the monetary policy changed dramatically since the beginning of the war. Before the war, we relied on the inflation targeting framework, very similar to many other central banks all around the world. But at the beginning of the war, we moved to another setup. We started to rely heavily on the stability of the exchange rate. We supported our actions on a fixed market with tough capital controls, and after some period of adjustment, so when we kept the interest rate stable at 10% in early June, so we raised it to 25% in order to help ourselves to maintain the stability of the exchange rate. And our last two monetary decisions were to keep this interest rate at 25%. At the same time, so as you rightly mentioned, so we struggled to improve the monetary transmission, which was not perfect before the war, and definitely it is even worse since the beginning of the war. But so far we see that our decisions, so they are translated into the banking rates more or less as we expected, and we hope that tighter monetary conditions will help us to maintain the stable exchange rate.
What will it take on the fiscal side? You were talking about the IMF aid and how much you might potentially need. How much would you need, and how long would it take overall to rebuild the economy in a way where you could go back to something more akin to normalcy?
Okay, so frankly speaking, the losses from the war are tremendous. So that relates both to the current situation when we have a huge budget gap, which we have to help to finance from the central bank side. And actually, this year we already provided more than $10 billion to the government in order to support the essential needs, financing the essential needs, and at the same time. That puts sizable pressure on the fixed market. Yeah.
We're running out of time here, Governor, and so I've got to keep this short and abrupt, and I'm being rude in doing that. Ukraine has had a courageous 2 weeks. The news flow has been extraordinarily good in the military front. What do you need from the allies right now? What do you need from Mr. Biden and the West right now?
Definitely, we need the continuation of the support both on military front and also continuation of financial aid. So we prove to the whole world that we have we may win, and we hope that with the continuation of the support from the democratic world, we will achieve the victory as soon as possible.
Thank you so much for joining us at Bloomberg today. Sergei Nikolaichuk of the National Bank of Ukraine here among this week of disunited nations. Really an extraordinary set of meetings, Lisa. I'm going to call it post-pandemic.
It's just shocking to see the consecutive rate hikes, and it's sort of who can out-hike the next in order to try to get some sort of stability in the currency. It's interesting, though, this conversation that we're having, and it highlights this delicate balance between fiscal and monetary. For so many years, monetary took precedence because it could, and now fiscal is sort of offset, and they're not in sync, and it's going to become a really political issue in the years to come.
It's a new experiment, and certainly, folks, we've seen that in the last number of days. If you're just joining us again, Bank of England with a modest surprise, 50 basis points, not 75. Sterling 113.25. Had a 112 handle a bit ago. Equity markets quiescent. The VIX 27.57. Dow futures up 80 points, and that is a good point to speak of Abby Joseph Cohen in this historic 2022, the professor from Columbia Business School. This is Bloomberg. Good morning.
What's happening on Wall Street?
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Surveillance on a Thursday. It's a Thursday of the Bank of England, yesterday a Wednesday of the Federal Reserve. But we go right back to the news that matters, and that is the state of the labor economy for Jerome Powell. And with weekly claims, Michael McKee. Michael, what do you see this morning?
Well, Tom, the Fed raised rates because the labor market is tight, and the labor market is still tight. 213,000 claims. That is the same as last month, unrevised, waiting for the revision to come across. But it does tell you that we are seeing a very strong labor market, still a chance for people to get jobs, even if they had lost their job, because continuing claims continue to fall. 1,379,000 compared with 1,403,000 last week. Well, these are two weeks behind, so the week before last. But it does show you that this is an incredibly strong labor market. At least it's showing no signs of cracking on the letting people go front. There was obviously a big exchange between the chairman and me yesterday, and the chairman and others, about unemployment and how high they're willing to let it go. But right now, it doesn't seem to be a problem.
Mike, is the Phillips curve in order right now? I mean, that didn't really come up yesterday, but I thought there was the real nuance of questions, starting with nonlinear items early in the conversation, then over to your rudeness later, made for a really interesting press conference. And within that is the theory, the canon theory we grew up, the Phillips curve. Is it in place?
It's still there, but it's being overlooked at this point. There is a big debate about whether or not it still holds. There was before the pandemic, because the Fed viewed it as extremely flat. But right now, because of the fact that the labor market has been, the labor force has been so small, it's kind of hard to tell. Not enough people going back to work, and an awful lot of job openings, and that shouldn't happen. Usually, if you have that many job openings, it lures people back to work. So they're looking more at the absolute numbers, and of course, as we pointed out yesterday, these are all backward looking, so it's hard for the Fed to know. But jobs claims are pretty contemporaneous, and they do show people are still on the job.
Mike McKee, thank you so much here with the mixed futures, red and green on the screen, the VIX 27.58. Is this joy, and how did we know it was an historic day of Japanese intervention? Bank of England action. To have Abby Joseph Cohen with us, professor at Columbia Business School, a modest career at Goldman Sachs as well. Abby, thank you so much for joining us here to keep us informed on the underlying finance and equations, the mathematics of these equity markets. Abby Joseph Cohen, suddenly the Sharpe ratio matters. I guess beta matters again, but outside of beta, we've got the risk-free rate, and it is returned with a vengeance. Are we revisiting the Sharpe ratio? Are we back to the articles you wrote for the CFA years ago?
Tom, wonderful question, and I'm going to respond by giving a bit of a prologue, which is that many models are broken, have been broken during this period of time, because they typically respond to cyclical phenomenon. For example, your question to Michael before about the Phillips curve. And the reality is that there are so many structural changes in the economy and the markets as well, that a lot of those models simply have not applied. Some of them are coming back in force. The Phillips curve, for example, had no way in its model to reflect the fact that there was a pandemic, that we have had this generational shift in labor force participation, by which I mean the baby boomers are now stepping out of the labor force. And the other thing, of course, is that we have had a 4-year deceleration, if you will, in terms of immigrants coming into the United States. And over the prior decade, immigrants filled 60 to 65% of the increase in employment in the United States. So there are a lot of things that are different. Within the market itself, a lot of the models haven't applied for a while. Keep in mind this weird 20 to 30-year period in which interest rates and inflation were extraordinarily low. And to your point, real rates reached negative levels, something we had never seen before. I, for one, now I'm answering your question, I'm happy to see that the Fed is now focused on making sure that real rates, real yields are in fact positive. And does the market believe them? And the reality is that we now have a flat to inverted yield curve, which suggests to me that bond investors, at least, are giving the Fed credence and credibility in terms of believing that the Fed policy will have efficacy.
Abby, are you saying that stock markets are not accurately reflecting the fact that inflation would be higher and would remain higher even after this cycle collapse if the Fed were not to keep rates at a much higher level than they had been?
Another very good question. Let me just talk about what happened yesterday in response, and that is the equity market didn't know what to do. First it was up, then it was down, then it was up, then it was down big time. There was really erratic behavior because, to your point, Lisa, equity investors are really confused because there is this yin-yang between inflation and higher yields versus will the economy and earnings continue to grow? And I think we're now at a point where, given the significant rises in interest rates and yields across the yield curve since the beginning of the year, the equity market is now focused much less on inflation and yields than it is on earnings. And there's a lot of confusion. Investors are not sure how this is going to play out for the rest of the year, let alone for 2023. We see, for example, that there are ongoing adjustments to the consensus earnings forecast, but let me point out, we are starting at record profit margins. It's not as if profit margins and ROE were low. ROE for the S&P 500 is in excess of 20%. So if there is, in fact, ongoing profit margin squeeze, I think the impact overall is not dramatic. The impact, however, in individual sectors may be significant.
Do you see the possibility of a lost decade, Abby, given the fact that we're trying to readjust and renormalize rates, renormalize some of the financialization of the economy?
You mean a lost decade in the
profits, in GDP, in a lot of things that people harken back to the 70s about?
Sure. I mean, if you look at the valuation of the U.S. equity market and some other markets as well, at the end of 2021, they were at record high levels in terms of where we were on percentiles. Almost every valuation model was between the 95th and 99th percentile, indicating, in my view, overvaluation. Unless you believe that the dream scenario of extremely low interest rates and strong profit growth would continue uninterrupted. So where are we now? The valuations are roughly at average levels. S&P 500 PE, for example, is about 16 times earnings. And given where we are, even with the rise in interest rates, that's not a bad place to be. So when we talk about the lost decade, let's talk about two different phases. Number one, we've now had a 20% correction in share prices from record high levels and record high valuations. Can we get back that 20%? I don't think that happens over the next several months. Over the next few quarters, I think the economy will slow, earnings growth will slow, but I think it's possible that we could see higher equity prices. I kind of peg that along the same lines of the growth in earnings, which is probably, what do we call it, 5 to 10% over the next few months.
Abby, a few years ago, you wrote an iconic paper for the CFA Institute. You mentioned an old strategist I used to talk to named Aristotle. Aristotle never saw a bond market with yield up, price down, and the losses that we've seen over the last year and a half. How do bond investors recover given this historic carnage?
The damage clearly has been much more dramatic in the bond market, and in some ways the overvaluation in bonds was much more extreme. We had central banks around the world who kept interest rates nominally extremely low levels, and real yields were low in many countries. You know, 2/3 of major economies, not the US, but 2/3 of major economies had negative real yields. So the damage that we've seen in the bond market, I think it was expected. When we look at government bonds, it's one thing. The damage in the credit markets is something that we've not yet seen fully rolled forward because a lot of those are illiquid securities, and I think we're going to see more damage ahead. But for the average investor who is willing to buy, for example, an individual bond, and now can get a 3 or 4% yield, depending upon the maturity they're willing to take on. That is something that is one of the best opportunities in 20 years.
Very good. Are you liking teaching, Abby? I mean, this is a whole different act for you. You're surviving Columbia. Do you throw chalk at people?
I do not throw chalk because we use whiteboards. So if I'm going to throw anything, it's going to be a marker. So I'm loving it, Tom. It's a great opportunity for me to be involved in the next generation.
Wonderful. You look tanned and rested. Thank you so much. Abby Joseph Cohen, professor at Columbia Business School. Thank you so much for joining us. I think it's fascinating, Lisa, to talk to her with her equity cred about the bond market losses. I just think it's tangible.
Especially because she said that there are some opportunities that may be the best in 20 years, even though she did seem to suggest that the credit market hasn't fully priced in this pain. Fascinating moment, and we're going to be talking about that, by the way, coming up with Mike Schumacher of Wells Fargo and Subhadra Rajappa of Societe Generale.
210 spread, negative 53 basis points. I mean, folks, we're looking at the screen here saying, not never, but yeah, never. We've never seen this kind of move in bonds. And you hear people like Abby Joseph Cohen, Michael Darden saying, let's go. This is the time to act. We're all frozen.
The last time that we saw an inversion like this was 1981 of this magnitude. And are we heading back to that era? And that is a pretty significant question. And one that will frame out the next decade.
You know, we're frozen. I mean, I'm looking at triple leveraged all cash and I'm going, let it go, let it go. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The Bank of England has delivered a second straight half-point hike in its fight against inflation. It was a split decision, though. 3 of the 9 policymakers voted for a bigger rate hike. The BOE also endorsed plans to start reducing government bond holdings built up since the financial crisis over a decade ago. Bloomberg's learned that Ukraine has seized dozens of tanks left by Russian forces fleeing the battlefield, and that adds crucial weaponry at a time Ukraine needs it. One person familiar with the matter says around 200 tanks were captured, but there's no word on how many of those vehicles were damaged or destroyed. A big sale for Airbus and a big blow to Boeing. A unit of China's Southern Airlines has agreed to buy 40 Airbus A320neos. The base price is almost $4.9 billion. The actual price will be lower after discounts. The planes will be delivered starting in 2024. Boeing has historically counted China Southern as its biggest customer. And Bloomberg's learned that SoftBank Group has slashed the valuation of Oyo Hotels on its books as it heads to an IPO. The once high-flying Indian startup was valued at $10 billion in 2019. Now SoftBank has cut its estimated value to $2.7 billion. In Manhattan, the hot rental market ended its 6-month streak of record-setting prices in August. New apartment leases were signed at a median price of $4,100, down $50 from July's all-time high. That's according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. The August median was up 17% from 3 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center. This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
On the David Rubenstein Show,
peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The reality is we take a mild recession today and eradicate inflation now because we know the mistakes of the past. That doesn't mean the Fed won't make a whole new set of mistakes, which is what I'm worried about.
It is Thursday. Diane Swank, chief economist at KPMG, yesterday with Richard Clarett, the former vice chairman of the Fed. I thought Ms. Swank and Dr. Clarett really were just lights out in their interpretation of the view forward. We look forward to reducing that early November. Right now, and I'm doing this for Global Wall Street, is a clinic. Ira Jersey, long ago and far away, worked for Global Wall Street. And he wrote the kind of notes where you'd get angry at him because they were 8 pages and you had to read every line, every paragraph, because they were loaded with intelligence about stuff you flunked in bond exams. The teacher joins us this morning running all of our interest rate strategy at Bloomberg Intelligence. Ira, I want to have a clinic right now on this strange word liquidity. In the old days, it was commercial paper. There was the wonderment of understanding LIBOR. It was out of like a Mary Poppins movie and all that. Great. It's all been blown up. How do you measure liquidity in the fixed income space in 2023?
Yeah, so there's a couple of different ways that we look at liquidity. One is obviously simple, like the bid offer between those people looking to buy, those people looking to sell. How wide is that? Where do market makers make those markets? And that has gotten a bit wider, particularly since the Federal Reserve backed off from its bond buying program, and then it's just gotten a little worse since the Fed started to actually run off its balance sheet. And then second, and I think this is important, and this is that plumbing you're talking about, Tom, and that's the repurchase agreement market. So what's going on under the hood? How do levered investors, so investors who are buying bonds with leverage, how do they get leverage and at what price do they get it? And they do that through the repurchase agreement market for Treasury securities and for a few other bond markets as well. And that market has not grown very much at all, while the Treasury market is now 4 times larger than it was before the global financial crisis. So you're looking at an environment where it's just harder to get as much leverage as you used to. And because of that, let's say that the pipe is the same size, but there's a lot more water trying to get through that pipe. And that's really the problem right now.
Should we be concerned about this plumbing? There's a doom crew that you in your career have pushed against every day. There's a doom and gloom crew that's going to write this weekend that the plumbing is fractured or rusty or broken in the banking fixed income space. Is it?
Well, I think it is in some ways, and part of this has to do with the regulatory environment that shifted a decade ago in response to the global financial crisis. So banks and dealers now have to hold a lot more capital, even against their Treasury securities, which, if they're not supposed to have credit risk, why do they have to hold a lot more credit against it? So this is the reason why a lot of regulators, the Federal Reserve, the SEC, are pushing toward things like central clearing of securities, because I guess theoretically, and the hope is that by having central clearing of Treasury securities, it'll just make things flow a little bit easier. People won't have to worry about if they're going to be delivered a bond or not, and if people are going to fail in actually executing that transaction and clearing it. So there are positives from trying to do that, but I think the bigger issue is just the amount of leverage in the system versus the size of the market. I think that's probably the bigger issue for why you're seeing moves of 10, 15, 20 basis points some days when on very little market news.
We harken back, and particularly this week with all going on in foreign exchange, to 1998, and part of it wasn't transparent. There were unknown unknowns, as Dr. Alarian would say. Do we have a knowledge of the liquidity of the American finance system, or are there unknown unknowns out there, shadows, if you will?
Well, there probably are unknown unknowns, and that's obviously scary because if there were, known unknowns, then we would at least have a clue as to what we should be looking for and looking at, right? But we don't. So there's always potential exogenous factors that could play into the financial markets, right? We had that significant, 15-minute, 50 basis point rally in Treasury securities in 2015 that is still kind of baffling, right? There has not been any really great explanation for why that happened. So there are certainly risks to the financial system, but the Treasury market in general is still one of the most liquid markets that we have. You can get off a significant size without moving the market very much, but it's still, because of the size of it, there's still a lot less liquidity than there was, say 4 or 5 years ago.
Completely unfair question, but it's Unfair Thursday, Ira. On Japan, the calculation from some like George Saravelos is 1% of reserves were spent today in this strengthening of Japanese yen. How much reserves can any given nation use before it becomes painful? Is it distant for a wealthy Japan, or is it too close?
Well, I think in the case of Japan, they have so many reserves vis-a-vis what they're trying to do that I don't, they can go very far.
Yeah.
And remember that central banks in particular, they can lever themselves by basically printing money, right? So they have the ability to potentially go the other way. Now, I don't think the Bank of Japan's problem right now is things like interest rate differentials, right? The fact that they didn't hike today, but they did intervene in the FX market is significantly different than if they had actually raised interest rates above zero, right? Which they still haven't done. So I think Japan is in a more unique situation than, say, Europe, right? Because Europe will eventually catch up to the US. So the way I see this playing out is the U.S. is going to stop hiking sometime in 2023, whether that's at 4.5% or 5%, somewhere in that range, which the dot plot yesterday that the Fed did showed. But eventually, the European Central Bank and the Bank of England, they're going to catch up. And as they start to catch up, you're going to see a turn in some of the currency markets, I think. And it's just a matter of timing as opposed to what the path will ultimately be.
What is your new research with your team on Jerome Powell's balance sheet? Was there something new to QT after the events of yesterday?
Yeah, no, it was still very much as we expected. They're going to let the balance sheet run off under the current system, probably through the end of the year, reevaluate maybe in December, definitely in January, and then decide on what they're going to do in the future. Now, I don't think that they're going to increase the pace of Treasury runoff, but I do think, and this is important, is that it's possible that they could decide at some point to start selling mortgage-backed securities. That's not imminent. That's probably not anything that you're going to see before next February or March. But it is something to keep on your radar, because if the Federal Reserve wants to run off its portfolio faster than it currently is, that's probably the only realistic way that they're going to do that.
An experiment in progress, to say the least. Ira Jersey, a clinic there on liquidity. Next time with Ira Jersey, we'll do solvency. Ira, thank you so much. If you want to flunk a fixed income test like I've enjoyed, folks, try to define solvency versus liquidity. Adults like Ira can do it, and me, not so much. Let's do a data check. We can do that with the VIX at 27.29. Spike out to 30 yesterday. Crisis. Abramowitz moved the market forward. 27.29 on the VIX. Dow up 107 points. Didn't make 29,000. 30,385. We do the Standard & Poor's 500 for John Farrow. Futures up 11. Stay with us. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
I'm Kaylee Lyons.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I've been told that this show will not start before I say good morning, good morning. So good morning from New York City for our viewers worldwide. I'm Lisa Abramowitz in for the wonderful Jonathan Ferro. Right now, we are looking at a market trying to find directions 30 minutes away. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Let's begin with the big issue, another hawkish message.
The Federal Reserve came out with a very hawkish policy response.
Jay Powell was very clear and out-hawked himself from Jackson Hole.
What was new was a little bit higher, a little bit more front-loaded.
After years of telling us to dismiss the dots, they're using it as forward guidance.
The Fed had confirmation bias with the CPI.
We're dealing with an uphill battle here.
Core inflation is looking sticky.
They really want to prove that they could actually corral inflation.
There still is opportunity.
TIA, there is an alternative. And that's the front end in yields.
The rates market's ready for it.
They reflect most of what the Fed is expected to do.
I think the Fed is still a bit fanciful on their forecasts.
It's a massive experiment. It's a credibility thing.
The biggest issue for the Fed is that they're choosing the lesser of two evils.
Joining us now to discuss, Societe Generale's Subhadra Japa and Mike Schumacher of Wells Fargo. Subhadra, your reaction to yesterday's meeting?
Well, I think the message is very clear, right? The message from the Fed is higher for longer. And they want to be able to front load rate hikes. If their target for the terminal Fed funds rate is around 4.6%, why not front load the rate hikes and get closer to 4.6% this year as opposed to next year, and then keep policy somewhat stable for the next couple of years, so there's no quick pivot. The Fed is going to be very steadfast in its approach to keeping inflation under control, and they're going to do everything it takes. And that's the message that I got from yesterday's FOMC meeting.
A number of strategists have been upgrading their forecasts for near-term rate hikes, including Citigroup. They are expecting another 75 basis points in November, writing, quote, "We are adding 25 basis points of cumulative hikes to our projections and now expect a 75 basis point hike in November, 50 basis point in December, 25 in February. The terminal rate going as high as 4.75%. Mike, do you agree?
475, it seems plausible. I agree with Subhadra, whether it's 460, 475. The Fed's pretty close to what the market's been telling us for a while, so I think it lines up nicely. In terms of another 75, it's ironic, frankly, we're talking about 75s and we're just almost complacent about them. These are huge rate moves. I suspect we probably will get another 75. Beyond that, it's tougher to tell. Yes, higher for longer, no quick shift from tightening to easing, but beyond the next meeting, I think it's frankly very difficult for even the Fed to know at this point.
Mike, are you getting the sense that perhaps risk assets are not accurately pricing in the pain that so many people are projecting? Morgan Stanley just putting out a note saying the FOMC reaction is no painless path to success.
Yeah, as far as risk assets go, it's interesting. I've been talking to a number of clients with respect to equities and whatnot over the last few weeks, and there's been a ton of focus on the increase in real yields. So if you think about it, look at the U.S. 10-year, for instance. The real yield was maybe positive 10 basis points back at the end of July. Now it's about 115 basis points, so a massive upswing. That's starting to get to the point where people say maybe the Fed is nearly done, so a similar message to what we heard yesterday. Not quite, but close. But still, if there's any more upside in real yields, and we think there is at Wells Fargo, it's probably not a great sign for risk.
Subhadra, do you agree with that real yields are poised to go even higher from here?
Absolutely. I completely agree with Mike. I'd say a good portion of my conversation with clients this past week has been about the rise in real yields. If you kind of go back to the past 3 to 6 months, the conversation was that, you know what, inflation expectations have risen, 10-year yields have gone up, but guess what? Real yields are still pretty low and close to zero. That paradigm has shifted. We're now at real yields above 100 basis points and the highest level we've seen in a while. So that has to sort of impact, you know, broader financial conditions as well as risky assets in particular. I would say that 10-year real yields are something that, you know, credit as well as equity investors are paying very close attention to. And there again, there's a potential that we see a further rise in real yields, given the fact that the market is giving the Fed a lot of credibility on inflation. So inflation expectations, broadly speaking, have been relatively contained. So the next leg higher in yields has to come from a rise in real yields if the Fed retains its credibility on inflation.
Subhadra, just to sort of put a bow on this, I'm looking right now at a 1.2% real yield in the 10-year. How high could that go? Are we going back to the 3% seen in 2002?
You know, that's a very you know, high bar and a hard ask in the current you know, circumstances. I still feel that the broadly speaking, I think risky assets have corrected lower. If we start heading, you know, significantly higher from here, I think you're going to see a lot of pain. The question for the Fed is how much pain are they willing to put up with? Because financial conditions are tightening quite meaningfully, and as they're raising rates and getting closer to 5%, I think the pain is going to be widespread.
Let's talk about some of that pain. Risk assets had a pretty immediate reaction yesterday to Chair Powell's testimony. Two-year yields rose to the highest levels going back to 2007, surpassing 4%. Let's bring in our own Taylor Riggs. Taylor.
Huge moves when you think about the yield market, Lisa, though. For our audience here, I'll quickly just start with those equity swings that you really highlighted as well. Not only the intraday volatility yesterday, but again today within the futures market. I really like the comments you had with Richard Clarity yesterday when you asked about the equity price reaction, and he said, you know what, let's wait until Thursday, wait until we digest and really understand how the markets are interpreting this new Federal Reserve. So today throughout this session, that is what we will continue to do. Long term, let's take a look here at the S&P 500, really now coming back off 20% from some of those recent highs. A lot had been made about the big rebound that we had in July and August, and then of course this rollover and a new narrative that once we broke through 3,900, would we get to see a new retest of those June lows? That is also something sort of long-term big picture on a technical basis we will be following. I wrap it up with yields as where you started, Lisa. Unbelievable. 11 straight days of yields rising, the tightening of the financial condition, a new repricing blowing through 4%. I know that you know this. 12 days ago, we were at a 343 406 is where we stand now on a 2-year yield.
It is just shocking, the pace of that move. Taylor, thank you so much. Subhadra Japa, Mike Schumacher still with us. Mike, we were talking earlier, I was speaking with Subhadra about the real yield and how high it could go. And it raises this issue of there is an alternative that Jeff Rosenberg of BlackRock was talking about, that suddenly this is a viable place to get income as opposed to going into risk. How much further could that real yield go before you start to get some disruptions that become less orderly?
When you asked Subhadra about 3%, I just about had a heart attack, so I think that's out of bounds.
Okay,
but
good to know.
150, maybe a little bit higher, perhaps in 10-year space, but these are getting to be pretty large numbers, and the 2% plus types of real yields that we saw years and years ago, I think they're probably out of bounds. And talking to investors who have a longer duration and typically focus on longer maturities, so let's say life insurers and whatnot, they've been scaling in. They've been adding to the duration positions and saying essentially, well, maybe this isn't the absolute peak, but it's a pretty good level. And I think with those flows already materializing, it means that while real yields go up a bit, they don't go skyrocketing. So I'll go with 150 as sort of a year-end type of target for the 10-year real.
Wow, but that still is quite a bit more to go, Mike. Just to sort of hammer home the point, do you think that this is a time to be buying 10-year Treasury yields, or is it too early?
I think it's getting close. And again, it's a function of how long is your horizon. For an investor who's got, or a hedger perhaps, a very short horizon, a couple months, probably not quite yet. But for someone who can take a view that's more like a 1 or a 2-year horizon, probably start adding. But it's a really interesting point. We talk about the 10-year a lot, but think about the front end. Lots of people are looking at front end rates and saying 4% plus in the 2-year, that's a pretty good place to sit for a while. I like the point that others have made that that's a good alternative to taking risk in the near term. I think you're going to see a lot of flows into the front end, probably a little bit less toward the back end of the Treasury curve.
Subhadra, is that kind of where you're sitting right now too?
I completely agree. Although that trade hasn't worked out for a good portion of this year, we have to kind of figure out where the end game is on how much the Fed will hike. But I completely agree with Mike in the sense that if you look at equities over the next 6 to 12 months, I mean, I think the trajectory seems to be one way as the Fed is raising rates. But I think this could be a very, very good opportunity to lock in some attractive returns in bonds, especially in shorter duration bonds, if you have the staying power to hold your position for the next couple of years. So, I think that yields are attractive. You're going to start seeing some of these 60-40 portfolio managers start to focus a little bit more on fixed income, given the fact that equities are performing so poorly.
So on the heels of some of these pretty big rate moves and this monumental sea change with negative rates being perhaps becoming increasingly extinct, there is a question of what happens when something breaks. And we were speaking yesterday with former Vice Chair of the Federal Reserve, Rich Clarida, and he was saying it may not happen in the U.S. It may happen externally, where you see the dollar pressures really start to bite. Mike, where are you looking for those tensions to boil over in a way that we have yet not seen?
Yeah, it's an excellent point. Usually if the U.S. dollar rallies for a long time, eventually something breaks. There are lots of reasons for that. The dollar is really how energy trades, for instance, very topical. A lot of these problems typically show up in emerging markets. So far, that's been okay. We got the news overnight from the BOJ, maybe intervenes in size, but still there are a lot of concerns with respect to currencies. I think perhaps the currency markets are the place to look. So most likely more on the emerging side, but it could hit some of the more industrialized countries as well. It's clear there's a lot of concern out there. So we're dollar bulls still, but we are nervous about it. We do think a bit more upside in the dollar probably exposes a few cracks in the system.
We'll continue this conversation. Mike Schumacher, Subhadra Japa, both of you are sticking with us. Right now, let's take a look at some of the stocks moving ahead of the opening bell. Abigail Doolittle's looking at what's going on. Abby.
Hey, Lisa. Well, it's interesting because we have futures basically flipping between very small gains and losses, but beneath the surface, some bigger movers, one of them being Robinhood. This, of course, in the Bloomberg exclusive earlier today that the SEC is to allow payment for order flow deals to continue. It's, of course, a very controversial way to process retail trades, but it's big dollars to a lot of these brokerages, including including Robinhood, basically allows them to sell trading rights to bigger firms to process those trades, such as Citadel. Microsoft up 0.2%, possibly its first up day in 6, up just 5 days out of 14 in September. Has everything to do with what you were just talking about, rates rising. Today, though, Microsoft investors looking past it ever so slightly. Banks higher with yields higher, but we also have yield curves steepening just a little bit, as you all were just talking about, so that is helping out banks modestly. And then finally, oil is up, this as the dollar is down. Lisa, take a look at Chevron, up 1.25%. Let's see whether or not that bid, that top sector for the year, if it can continue. Maybe one place to hide.
Yeah, Abigail, thank you so much for that. Coming up, Fed Chair Powell turning more hawkish and less optimistic.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't. We don't know. No one knows whether this process will lead to a recession.
Well, some lawmakers on the Hill starting to push back a bit. That conversation coming up next. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't. Reducing inflation is likely to require a sustained period of below-trend growth. And there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. The median for the year end suggests another 125 basis points in rate increases.
Chair Powell's message, rather bleak messaging, triggering a response from Washington, D.C. Senator Warren voicing her concerns, tweeting, quote, "I've been warning that Chair Powell's Fed would throw millions of Americans out of work, and I fear he's already on the path to do so." This, of course, with midterms quickly approaching and the Fed's next rate decision just 6 days before those elections. Former Vice Chair Rich Clarida of the Federal Reserve weighing in on the political pressure. Take a listen.
At least until inflation comes down compellingly, as the chair said, I think you want to fade that dovish pivot sentiment. The committee will try to tee up 75 as the expectation, and I think that's what they have to do.
Do you worry about this institution, though, becoming a political football once unemployment starts to climb?
One of the consequences of the inflation overshoot is that it's going to trigger that pressure. But I think the institution will survive it.
Michael McKee joining us now from Washington, D.C. Mike, this is an increasing question for the Fed, especially as nobody, especially politicians, do not want to see unemployment going up. In the circles you speak to, how much concern is there about increasing politicization of this Federal Reserve?
Well, there's not a concern at the Fed about politics. The standard answer is we don't pay any attention to it. We just do what we need to do for the good of the U.S. economy. But they can't avoid political pressure from Capitol Hill. The question is, what can members of Congress do about it? Now, the math is that if the Fed raises rates, unemployment always follows by rising higher. And if you do the math on the Fed's rate right now, forecast of about 4.4 to 4.6%, you're talking about 1.5 million people who would lose their jobs. It hasn't started yet. You can see unemployment hasn't started to rise again. But that's in theory what's coming. And then for the Fed, the calendar works against them because 125 basis points more. They've only got 2 more meetings this year. So 75 at one of them, 50 at another. And look what happens right after, 1 week after the next Fed meeting. It's election day. So they could become a political piñata in that week if people are looking for somebody to blame for bad economic news. And then the new Congress is sworn in shortly after the last Fed meeting of the year. And if Republicans take over, they have vowed to investigate the Fed. It's something they do quite regularly when they run Congress. So there could be problems for the Fed, but will it change anything they do? Probably not, because there isn't a whole lot that people can do. And Jay Powell yesterday made it clear that he has learned the lessons of the past. On the left-hand side there, you have Arthur Burns cutting interest rates as inflation was rising in order to help Richard Nixon's reelection. And then you have Paul Volcker's mistake of starting to cut rates too soon before inflation was vanquished. So over on the right-hand side, that's where Jay Powell is right now. And he doesn't want to do either of those two things because they didn't work out well for his predecessors. He's going to keep on doing what he's doing despite the political pressure.
Michael McKee, thank you. And I appreciate you bringing the historical references in to show this political pressure isn't exactly new. Subhadra Rajappa, Mike Schumacher, both of you back with us. Subhadra, how closely are you watching this, the political aspects of not only pushback against the Federal Reserve, but a lack of willingness to finance new fiscal outreaches because of the inflationary backdrop?
Well, I think part of the reason why we are where we are is because of the fiscal largesse, right? So in some respects, I think more fiscal spending is only going to exacerbate the situation that we're currently in. I think that a lot of this is just political rhetoric going into year end and into the elections. So I think that it's really hard to sort of read too much into the political ramifications. The Fed has made it clear that regardless of what they hear from anyone else, they're going to kind of, stay the course and continue to raise rates because they just don't want to be in a situation where they pivot too quickly and then have to kind of reverse course again and hike rates again, as Mike pointed out earlier.
Subhadra, just real quick, a follow-up. Do you think that the inflation is such that it would be of that nature if they stopped raising rates too soon?
Inflation is on a trajectory, led by sort of a broad spectrum of forces that are pushing inflation higher. So it's not one thing or the other. So you really need to see a variety of metrics that the Fed's tracking start to ease up a bit. So, for the most part, the Fed is focused on, trying to raise rates. We know that policy is a very blunt tool in dealing with this type of broad-based, metrics of inflation, but that's the only tool they have, and they're going to keep doing it till they see an easing of inflationary pressures in broader markets.
Mike, I asked this question. We were speaking with Denny Blanchflower of Dartmouth earlier this morning, and he's railed against raising rates too aggressively, saying that it's much more detrimental to the economy to see jobless rates go up because they tend to be stickier, and just to allow a natural progression to just extend the time frame of how long it takes for inflation to go down. Do you think this inflation is different, that we're not going back to a low-growth, low-inflation regime like we got used to over the past few decades?
Yeah, I certainly disagree with the view from our friend at Dartmouth. And when you consider the implications of letting inflation stay high, they're pernicious. High inflation really digs at society. So the idea of the Fed letting inflation come down slowly, organically, doesn't really seem like a good tack to me. And I think the big risk, and Subhadra was chatting about this a minute ago, is that inflation comes down but stays at an uncomfortably high level. So maybe the run rate goes to 3.5, and then what? Then expectations get baked in, people expect wage increases. That's a bad environment. So I think that's a poor way to go. I doubt the Fed will take that approach.
Mike, given that backdrop, what do you think about credit? Because we've heard such controversy over whether it's a good time to buy, for example, high-yield bonds with nearly a 9% all-in yield, or whether it's a bad time because they're going to go to 12% when you start to get the actual earnings revisions downwards.
Yeah, my colleagues at Wells are still bearish on credit. I'm overall bearish on risk. I agree with that sentiment. If you think about high yield over the years, typically you'll see that yield get up to around 10% really at the peak before it's a reasonable time to get in size. So I'd say 9, probably a decent waypoint, but not really the right level yet. And when you think about investment grade, again, we're a bit bearish still in terms of treasury yields. Our colleagues think spreads go out. It's not a good recipe, so we think it's premature.
Subhadra, final thought?
Well, yeah, no, absolutely. I think that, credit spreads have more room to widen, especially if you're going to head into some sort of a hard landing situation or even a mild recession. We definitely see more room for credit spreads to widen in this context. The question really is that we just don't see anything, any sort of risks of a recession being really priced into any of the metrics that we look at. Credit spreads don't show any signs of a recession. Corporate profit margins, broadly speaking, are very healthy. So we've just not started pricing in a recession yet in any of the metrics in credit. So I think that's still yet to come.
Subhadra, Mike, thank you both so much. Subhadra Rajappa and Mike Schumacher joining us. Coming up, the morning calls and later BlackRock's Jean Bovin calling the current economic conditions worse than the financial crisis. Wow, just gloom and doom across the board, so many places. Jean Bovin joins us at the opening bell. We're trying to find direction here as we reassess after yesterday's sell-off. The direction momentarily is lower, at least in the S&P. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. As the session grows just a little bit closer to the open, a little bit more bearish across the board. The NASDAQ leading the losses, down almost 0.5% after the Fed meeting yesterday. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, RBC Capital initiating coverage on Nike with an outperform, saying the company has an unrivaled leadership position in the sportswear category. Next up, Wolfe Research downgrading Alcoa to peer perform, expecting macro factors to weigh on the aluminum bull case. And finally, UBS upgrading Eli Lilly to buy, labeling it the most attractive stock in the large caps pharma space. Coming up, the gloom just keeps coming as people reassess the likelihood or the unlikelihood of a soft landing. BlackRock's Jean Pauvin calling today's economic conditions worse than the financial crisis. This is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Earlier, markets couldn't decide. Now they are decidedly down. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of the trading day, and we have found a direction. It is lower. It is in the red. NASDAQ down 0.6%. You can see S&P down 0.3%. In the bond market, you are seeing those two-year yields continuing to climb higher as people reassess what it means for a hawkish Fed. 10-year yields also rising 3.6%. A bit of dollar strength generally, although the euro is gaining a little bit of ground, but still, wow, 98 handle, talking about euro devaluation, and crude a little bit higher. Really a mixed picture, though, as people try to understand how much more pain there needs to be in order to get something of inflation coming lower and a Fed that feels comfortable enough to pause. Joining us now with a look at the stocks moving ahead of the opening bell, Abigail Doolittle.
Well, Lisa, that move in yields, it's really just stunning. Either that 10-year yield now at 3.65 or the 2-year yield above 4%. It's just incredible, really weighing on tech in particular. That's taken Meta Platforms lower. Earlier, it had been higher, of course, on the news, the Wall Street Journal report that came out yesterday that they are planning on cutting costs by 10%, allowing for job attrition. Morgan Stanley analyst Brian Nowak says it will help the bottom line. There we have a small gain. Let's see what happens on the day. ExxonMobil higher with oil up, as you just outlined, up 1.6%. Of course, the down dollar helping oil on the day. It's interesting, though, that the demand outlook based on what the Fed's saying, you would think that maybe oil wouldn't be down, but it is. Robinhood up nearly 9%. This, of course, is the SEC is allowing payments for order flow, basically allowing them to take payment to send retail orders to other brokerages. Very controversial, but it's sticking in place, at least for now. And then finally, here's a big laggard, Darden Restaurants. Think Olive Garden, Longhorn Steak, down 2%. They missed comp. Both of those companies, those restaurants missed. They did hold the outlook, so maybe they're seeing something brighter at the end of the year. A little bit of a different picture than what Fed Chair Jay Powell was talking about yesterday, Lisa.
Thank you so much, Abby. I'm sure we'll get a full analysis of the breadsticks tomorrow. We'll discuss it, I'm sure. On Bloomberg Surveillance, right now, tech stocks extending their declines after closing at their lowest level in more than 2 months. Bloomberg's Ed Ludlow joining us now for more. Ed, tech has gotten such a beating. How much further?
Yeah, I mean, we're modestly lower, 0.2% on the NASDAQ 100, 0.3% on the Philadelphia Semiconductor Index. The NASDAQ 100 reacted to Powell with gyrations, right? And then we closed at an early July low. The surprise was not 75 basis points. It was the forecast from officials of 4.4% rates by the end of this year and a terminal rate of 4.6%, which calls into question global growth, right? Many of the laggards in recent weeks have been mega caps, strong balance sheets, entrenched market positions, but they're concerned about inflation and global growth. Even with valuations coming down, we see price pressures. Bloomberg's Emily Chang spoke to Microsoft CEO Satya Nadella in the last 24 hours, and this is what's top of mind for him right now. Take a listen.
The constraints are real. Inflation is definitely all around us. And different parts of the world have different type of economic growth, but the constraints, I think, are being felt by everyone.
The constraints are real, and how big a story has the stronger dollar been for names like Microsoft, who have seen their earnings hit from that regard? The other thing we continue to see is more speculative corners of the market get hit, but I just cannot get over how much decline we see in the mega caps, who time and again analysts talk about being more resilient in a difficult macroeconomic environment, but we are still continuing to see pain, and we worry now about that R word, recession.
Ed Ludlow, thank you so much. The big banks grappling with that as well, and looking to rebound from 2 days of steep losses. The Fed's jumbo rate hike sending the sector down more than 2% yesterday alone. Bloomberg's Katie Greifeld joining us now for more. Katie.
Well, Lisa, it's definitely the Wall Street banks versus the central banks. And looking at my first chart here, it's the big banks that are losing the battle. Like you said, the sector just falling more than 2% after the Fed's third straight 75 basis point hike yesterday. We're trying to regain a little bit of ground this morning, not doing too well, though. But for all the talks of higher rates hitting tech, you just heard it again from Mr. Ludlow there, banks are doing even worse. If you look back since the first hike of this cycle, all the way back on March 15th, communication stocks, of course, have absolutely cratered, but it's the financials that are lower by almost 14%, underperforming the tech sector even. And that's interesting for a few reasons, Lisa. One of the biggest being that higher rates normally thought to help bank stocks. It's not the dynamic this time, as you can see from this chart. The 10-year Treasury yield in yellow there, breaking apart from financials. A potential reason why is that even though you do have higher long end rates, it's the yield curve that's deeply inverted. So it makes it a little bit more difficult to borrow short and lend long.
Katie Greifeld, thank you so much. And talking about banks, big bank executives facing yet another second day of questioning on Congress, returning to Capitol Hill after JP Morgan's Jamie Dimon took a firm stance on fossil fuels. Take a listen.
Does your bank have a policy against funding new oil and gas products? Mr. Dimon.
Absolutely not, and that would be the road to hell for America. We aren't getting this one right. Investing in the oil and gas complex is good for reducing CO2.
Bloomberg's Sonali Basak joining us now for more. Sonali, really interesting, wide-ranging discussion. It comes at a time of a real pivot in the economy with the Fed. How much more do you think that the banks are going to weigh into this? Do they want to see higher rates? Do they not? What's their outlook?
Well, it's that balance with employment. And you see in the start of the hearing today at the Senate, there's another issue. Everything is politics, Lisa, but there's another issue that is coming front and center right at the beginning. There is a photo, a picture, a board, if you will, behind Sherrod Brown, the chairman of the committee, that shows CEO to pay ratios, which, as we know, So pay has gotten much higher over the last couple of years as the banks have done well, but are now more under pressure. So those ratios are clearly of concern. Remember, some of the banks that are testifying today have raised their minimum wage. They've cited that in their prepared remarks. We saw Wells Fargo really under fire yesterday, really coming under fire for starting to let go of workers. In Iowa, for example, that's 9 rounds of firing. They were very specific about it yesterday. So you have lawmakers that are worried about their communities, about those jobs, in addition to inflation. So at one point, Lisa, I know you were paying attention to this, the Fed being politicized, every action that we see of real concern here. And at one point, you saw lawmakers ask the bankers, particularly Jamie Dimon, whether the Fed's dual mandate was appropriate. And while Jamie Dimon said that it was appropriate, he said it should be monitored. I want to do a little bit of a pivot here as well, Lisa, because at yesterday's hearing, you had lawmakers very concerned and very upset that the bankers were there, but the SEC was not, that Chairman Gensler had not testified to that committee. And what you're seeing today, I want to pivot a little bit to this Bloomberg scoop of the SEC really leaning away from really a full-on ban on payment for order flow deals. If you take a look at that there, that has an immediate impact on the stocks. You have Robinhood jumping almost 10%. You have Virtu jumping more than 7%. And this is something that may still see changes. But again, how much things might change for Wall Street on the regulatory front is clearly under fire, as everything they do is enormously politicized.
Sonali Basak, thank you so much. BlackRock seeing a difficult path for central bankers ahead, writing, quote, "This is the most difficult economic environment to navigate in half a century. Even more than the financial crisis, there's no desirable outcome at this stage. The question is, which is the least bad?" Joining us now is BlackRock's Jean Beauvais, who penned that rather dire missive. Jean, why would you say that it is worse than the financial crisis in terms of the depth, in terms of the duration, or in terms of the unpredictability and how to deal with things?
Good morning, Lisa. Great to be here. You know, the financial crisis was a very difficult situation. I don't want to underplay that by any means, but in terms of what needed to be done, it was a whatever it takes kind of situation. And we ended up, seeing powerful measures being deployed. And at the end of the day, you know, the remedy, the cure was the right thing for growth, was the right thing for inflation. Took a long time, but that was a pretty easy set of policy to figure out what to do. Right now, we're facing conflicts between stabilizing growth and inflation like we haven't seen in 40 years at least. I think they are of a nature we've never seen, in fact. And that conflict makes the decision, the choice, far from trivial and much more difficult than they were in the financial crisis.
Do you think that markets are accurately pricing this in?
No, we don't think so. And I think the central bankers are starting to move in that direction of reflecting this very sharp trade-off, but they're not yet there. So both the central banks are not reflecting that, and the markets are not reflecting that. If we want to stabilize inflation quickly on a path that looks like what the path it's forecasting for inflation, that would require a cost on activity and employment that is very significant. We think it's a 2% decline in GDP in activity and 3 million jobs that will need to be lost in the U.S. That's not reflected in markets.
Okay, so that's something that you also don't think that central banks are reflecting in their rhetoric. They're getting a little closer, but we heard yesterday from Diane Swonk, they're still in a little bit of a fanciful land when it comes to how deep that pain is. You said markets are not reflecting that either. What would the consequence be for, say, the S&P 500, for, say, big tech companies, if this realization does start to settle in?
So I think what we are heading for now, and nothing in the decision yesterday in the press conference has dissuaded us from this view that we're on a real path towards over-tightening. So the central bank is going to be looking for evidence that inflation is decisively on the path to 2% before questioning any of their plans at this stage. The problem is inflation will only really come down once we've seen very significant decline in activity. So I think we have a clear sequencing from here. Over-tightening, then we'll see the economic damage in second, and then only after that, and after many months of lags, we'll see the inflation impact. So that means that for now, I think this is going to be putting pressure on broad markets, and any interest rate sensitive part of the stock market will be most directly impacted. I think that will continue for the next few months. That's why we're underweight DM equities for the time being, and we'll need to see central banks starting to question more fundamentally and bringing these trade-offs more explicitly before we see a more constructive backdrop.
And this is really raising a question when you say interest rate sensitive parts of the equity markets. Do you see 10-year yields going substantially higher from here? Or are you starting to see this as a good place to hide? And this has really been a big point of contention over the past couple of days.
Well, the moves have been very significant. We've been having a very high conviction for the last, many months, even I would say the last couple of years, that very high conviction underweight for 10-year or longer-term treasuries. That has been now reflected a lot more in the price. We still think that that's some room to go. So I don't find that necessarily now tipping and becoming more attractive. The inflation story will still surprise on the upside for some time. I think the Fed is not done surprising, moving in that direction. I think now we're pricing 4.5 maybe as a terminal rate. I think the risks are to the upside of that for now. So that's an environment where I would see still yields moving higher from here on a 10-year.
So there's another issue here that's raising a lot of angst for people, which is the United States is looking worse and worse as the Fed continues with its rate hiking path. But it looks a lot better than other places, which is the reason why the dollar keeps gaining. At what point does that switch? At what point does that become less of a clear-cut dynamic?
I think there are two key drivers of the dollar, like in general. I mean, there's the interest rate differential with other regions, and clearly this is at play here. And then the other is the broad risk, the global risk-off, risk-on sentiment. Right now, I see the two drivers working in the same direction. So we have the Fed surprising, very aggressively moving with rate hikes, going on the over-tightening, that's supporting the dollar. And the second is that is also contributing to the global risk-off, which is also, adding to the bid to the U.S. dollar. So I think that's going to switch only more or less very similarly to the broad market risk sentiment. I think it's going to be when we get more clarity on the size and extent of this downturn, which we think is real, but how much we'll need to see. And when we see the central banks, the Fed in particular, as I said before, start to acknowledge the trade-off that they need to manage and navigate. So once we get a sense that this is happening, I think we'll see some of the pressure on the U.S. dollar cooling off. But until then, I think this is pretty much two big drivers working in the same direction.
Jean-Bovin, we'll be continuing this conversation. You'll be sticking with us. Up next, a marathon week filled with global central bank rate decisions. Take a listen.
We came to the conclusion that it's the right time to tighten monetary policy and especially to go from negative to positive short-term interest rates.
And then, of course, the Swiss franc still sold off in the wake of that decision. That conversation coming up next from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The inflationary pressure in Switzerland increased. If you look at our inflation forecast, slightly different, even if you include the interest rate hike. So we came to the conclusion that it's the right time to tighten monetary policy and especially to go from negative to positive short-term interest rates.
Everyone's hiking rates, it seems, except for one, the Bank of Japan. A host of central banks out with rate decisions today. Norway, Switzerland, Taiwan, and the United Kingdom all following the Fed with hikes. Bloomberg's Michael McKee is back with us for more. Mike, with the exception of Japan, regime change across the board.
Regime change across the board continues, and we even had one more. South Africa just raised its central bank rate by 75 basis points. And it's remarkable not just for the fact that they're moving higher, but they're moving higher in very big chunks following the Fed. The biggest reaction, of course, is always in the currency markets. The pound gained a little bit back, but it's still way down, and it's starting to lose its gains. We're seeing the Swissy down against its biggest trading partner, the euro. As you mentioned, the Bank of Japan did not make a change. We're still seeing weakness there because the Japanese are using this as an opportunity to get inflation up. They would like to see more inflation. They're the only country in the world that really wants that right now. And then finally, the Norwegians are down against the euro because they too are raising rates, and that has an impact on oil prices. But the old saying, it's our dollar but their problem, also rebounds in this situation to the United States, because when the blue line goes down, the yellow line goes down and the white line go down, and the blue line is the exports that the U.S. Exports to the rest of the world. The white line, the Bloomberg Dollar Index, and when the dollar falls, we sell less because our products get more expensive, and that means there are jobs lost in manufacturing. So even though the dollar is really strong, its long-run impact isn't always going to be great. And so the dollar and the Fed have to figure out, what are they going to trade off here? And what we're getting is a global recession instead of an improvement in the terms of trade. If you look at the British and the European odds of recession, they've gone way up. Europe now, 72%. And what is a global recession going to do for anybody? Not a whole lot, and it isn't going to help the United States either. So then the question starts to arise, do you need to do something about it? The Japanese intervened today. It'll probably fail. There's not enough yen in the world to move that market for the Bank of Japan. But do we need some sort of overall move on currency? That's a question that will be asked more and more.
Yeah, the whole idea of coordination between the central banks. Michael McKee, thank you so much. BlackRock's Jean Bovin is back with us. And Jean, I want to start with Japan and the move overnight and their commitment to yield curve control as everybody else moves in the opposite direction. How close are we to an accident that forces the Japanese officials' hands?
Well, that's very difficult to answer. It's under control until it's not. It's one of those things, and it is the case that there's a lot more chatter about whether they're going to be able to sustain it or not, and I guess market participants betting on this one way or the other. I think that the Japanese situation is very different, as was just explained. Inflation is a good story there. The need to change policy stance is not at all the same as you would see elsewhere. So it becomes more of a global pressure coming from interest rate differentials and currencies, a market participant. I think the resolve is there, but when it breaks, it's very difficult to predict. I think even when the Bank of England went off the European monetary system, it was not necessarily obvious before it happened. So difficult to say.
And the problem is that Bank of Japan is an outlier in one sense, but a trendsetter in another. Evercore ISI weighing in on Japan's FX intervention rating, quote, "The intervention shows Japan wants to limit yen weakness, but not at the price of changing monetary policy. It is not alone. China's People's Bank of China is also staying dovish and tolerating FX weakness." At what point, Jean, based on some of the interventions that we're seeing around the world, at what point is there sort of a trigger that reaches? Where does something break? And that's something that we were discussing yesterday. Are we reaching any breaking points in the currency realm?
I think, to my mind, the breaking point is not immediately about some kind of financial pressure or breaking points. I think it's more the fact that we're seeing very significant dollar appreciation that is putting pressure on the global economy in a significant way. I think it's useful to remember 2013 when the mere talk of starting to slow down the purchase of the asset purchase for the central bank created a massive tantrum, as we know, in the emerging market world. We've raised rates in the U.S. by 300 basis points over the course of a few months, and we haven't seen yet those kind of cracks. So I think this is where when we're going to start to see that, then that could trigger a more bigger adjustment, maybe discussions about intervention at a bigger scale and some form of coordination. But surprisingly, I guess, we haven't really seen that yet.
Jean Boivin, thank you so much for taking the time. Fascinating concepts in a moment that seems historic on many levels. Regime change in the yield space, regime change in the inflation space, regime change when it comes to a lot of leadership across the world. Coming up, the market moving events that you need to be watching. That's next in our trading diary. Right now, markets are a little bit of a risk-off tone as yields continue to just edge a little higher. This is Bloomberg.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. We are 25 minutes into the session, and the gloom is sticking. Almost 1% down on the NASDAQ, and the S&P down nearly 0.7%. Yields continuing to climb, reassessing the hawkish resolve of this central bank in the U.S. as well as around the world. Time now for your trading diary. What you need to be watching this week: FedEx and Costco earnings coming after the closing bell. We'll get U.S. PMIs on Friday. Plus, we'll hear from Fed Chair Jay Powell, talking perhaps more about the hawkish move that they're making. Then looking ahead to next week, Fed Speak continues with Collins, Bostic, and Mestre on Monday. Plus, Powell, Evans, and Daly speaking on Tuesday, the return of Fed Speak after the quiet period. This was a countdown to the open on a day where we're seeing just one hawkish move after another for central banks around the world. This is Bloomberg.
Connection lost.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure, Still, he had to attend the 2-branch hearing otherwise. For not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi